I'm Meg Szabo, and I'm delighted to welcome you today to the Bloomberg Sustainable Business Summit, Focus on Finance. Over the next 2 days, we'll convene global leaders for conversations focused on making the financial case for sustainability. We'll cover a wide range of topics, from emerging regulatory and reporting trends to how to maximize performance while providing a positive social and environmental impact. But before we get started, a couple of announcements. First, I would like to acknowledge our global advisor, Natixis Investment Managers, and our summit advisors, BMO, Flex, Salesforce and Accenture, Schroders, Wells Fargo. If you experience any issues at all with your audio or video quality, please just refresh your browser or use that chat box at the bottom right corner of your screen for support. And we would love to hear from you today. If you have any questions at all for today's speakers, please just type them in the white tab to the right of the video window and hit submit. And you can also engage with us on social media all day using the hashtag SustainableBizSummit. And you can also engage with our other attendees in the event chat at the bottom right corner of your screen. And with that, let's get started with our program. Please join me in welcoming Bjorn Anwal, Chief Financial Officer of Volvo Cars, for a conversation with Bloomberg's Rafaela Lindeberg.
Hello, I'm Rafaela Lindeberg, and I'm a reporter with Bloomberg News in Stockholm. I'm thrilled to be joined by Volvo Cars Chief Financial Officer Bjorn Anwal for a discussion on sustainability. Bjorn, thank you for being here for our virtual Sustainable Business Summit. This session is about Volvo Cars and your company's path towards a more sustainable future, and not the least, the financial case for it. And I've heard from your communications team that you are quite passionate about this subject, and according to some sources, you actually are keeping a copy of the IPCC report on your desk at the office. Is that true?
It's some part of it I do, but I also keep, and I think that's more important, a copy of our sustainability strategy in my little notebook that I carry everywhere. Because in the end, it's good with the IPCC report, but what we do is more important.
And given that transport is said to account for 10% of global carbon emissions, it would be great if you could perhaps start with a quick run through of how you think the auto industry is part of the climate crisis.
No, I think, as you said, 10-15% of the greenhouse emissions in the world comes from road transportation. So clearly the automotive industry is a big part of the problem and has to very quickly become part of the solution. And we need to get to climate neutral, fossil-free and greenhouse emission neutral net zero by 2050. And in order to get there, clearly we need to get out of combustion engines. And that has to happen quite quick, and that's exactly Volvo's stance into this. We want Volvo to be a fast transformer and be a catalyst for the whole sector to change into a sustainable future. So Volvo's targets is to be climate neutral by 2040, and the only way to get there is to get out of the internal combustion engine by 2030 and start the transition into full electric cars already now, and that's our strategy.
Yeah, about these targets you set up, that is quite an ambition given that your sales of fully electric cars is still below 5%, right? Based on Q3 sales.
It is a challenge, and it's a marathon, and our plan and strategy is very, very clear. We said from the beginning that what stops the world from going fully electric, there are three major hurdles that we need to, as a society, to get over. First of all is the cost of fully electric cars. It needs to be a technology that's affordable for more people. Secondly, in order to rely on fully electric cars, there has to be a fast charging network so that you can also drive long distances when you need to. And thirdly, it always takes time to change consumer behaviors. So those are the three hurdles. And our strategy was then, okay, let's do this in 2 steps. Steps 1, let's do plug-in hybrids, which are then part-time electric cars. That solves those problems because the cost is lower. You're not relying on the fast charging network. And on top of that, you get the consumers to get some time to learn this new technology. How do you charge? Where do you charge? And how does that work? So our strategy has been to do that. And we have plug-in hybrid technology in all our cars, and it's now constitute a third of our sales globally. So a third of all the Volvo sales today is with Accord, but the most of them are then part-time electric car, as I call them. Now, from the point we are today up until the future, now the focus is on fully electric cars. And we have 2 fully electric cars in the market, the XC40 BEV and the C40. And the capacity for them are right now, from a production point of view, quite limited, but the demand is really high. And we are now quickly ramping up our production. So the production for those 2 cars goes from 15,000 a year right now up to 150,000 a year after summer. So now we get the supply, and therefore we can also increase the sales quite rapidly. And then we are launching an additional full electric car every year in the coming years. And Volvo, as you know, is a company which has a quite limited product lineup with 7 cars. So in a very short period of time, we can shift the epicenter of our sales from plug-in hybrid today into fully electric cars in a few years. And more than half of our sales should be fully electric by 2025.
Can you tell us how your targets measure and compare to other traditional car makers? How does this approach differ to competition?
In general, I would say that you see more and more traditional automakers coming out with clearer and clearer strategies when it comes to electrification. And I think what differs in the rhetoric now is more the timing. I think everybody believes that we see a need to go to a full electric future. And then the question is, how quickly can we do it, and how quickly are different companies aspiring to do it? And we have the fastest plan in the industry among the traditional players to go fully electric. And I think we can have that because Volvo is it's a premium brand. It's a relatively small brand, and we also have a consumer group that cares a lot about safety in general. Planetary safety and sustainability is very important for the Volvo consumers. So they expect Volvo to take the same lead in the race to net zero when it comes to carbon emission, as we've always been in the lead in the race to net zero of fatalities and injuries in road traffic. And so it fits very well with the Volvo consumer, and that's why I believe we have an obligation and a big opportunity to do this quicker than anybody else. And I think that's a question I got a lot, is this really profitable? And in my mind, being on the right side of progress is always profitable. And this is where the industry needs to go faster and more determined than competition is typically a good thing. If you want to grow, you should focus on the growing part of the market, and the full electric premium car market is the fastest growing part of our market. So that's our focus.
Well, we're talking enormous investments, and how are you going about this to reach that kind of capacity we are talking about?
No, it's a good question. It is an enormous investment, but you should also remember that automotive companies make enormous investments every year in development and capex in tooling and setting up factories. So it's not a question of and, it's mostly a question of instead of. So now we are stopping the development on internal combustion engines. We are not doing any investment into our factories when it comes to the production of combustion cars. And instead, we devote all of those resources into a fully electric future. So that's the main story. Then there are some things we do on top. So we have now taken the full consequences of not seeing a future for the internal combustion engine and fully spun off our internal combustion engine factories, I should say. We had 2 of them, and then we're now spun off, so we don't manage that any longer. So we do less of that, and instead we invest our efforts and our money into building up our competence when it comes to battery cell chemistry, the electric motor, the whole battery management system, and all the things that you need to make the electric propulsion system really efficient for the future. So yes, there are some extra investment, but most of this is stop doing that and instead doing this.
We actually got a question from the audience asking, this is going to be a highly competitive market. How is Volvo going to be more competitive on a hot market?
It's a good question, and I think it comes down to focus. And that's where Volvo has made the choice that we don't believe in investing into the old internal combustion engines and the platforms that are has an internal combustion engine, but all our efforts and all our technology development now goes into a full electric core architecture, core compute architecture platform. That's of course a risk. There is a risk that some consumers feel that the internal combustion engines needs to be there longer. So we take a risk, but instead we focus on making what we see as the future of the automotive industry really good and really competitive. So we need to focus, and I think we are focusing more than our traditional competitors. And then, of course, we have a set of inspiring and exciting new competitors in the automotive industry who's only doing one thing, and that is focusing on the fully electric future. So they have a bit of an advantage of being 100% focused, but on the other hand, we have a big advantage of all the things we learned from the past. How do you put together a car in a quality assured way? How do you make a car really safe? When cars break down or get scratches, because also fully electric cars will get scratches, unfortunately, where can they be serviced from a good retail network? So we have some assets that we then put together with this determined focus, and that combination of taking the strength from the past and a determined focus for the future, that's Volvo's recipe for being successful here. Mm.
Obviously, you were present at COP26 on Transportation Day. We have this big declaration from the countries and from manufacturers to phase out fossil fuel vehicles. And it became quite a big part of the narrative around those days in Glasgow. Who signed up and who didn't, and why didn't they? How would you summarize this and the turnout from the meeting?
So one of the things I think was good in Glasgow compared to maybe earlier conventions like this is that it was much more focused on actions here and now. So I think it's starting to be more about how and less about if and when. That was a good part of it. And when it comes to the auto industry, I mean, this declaration that the industry aims to get out of combustion engines, I think we said in most countries in 25 and in 2035 and globally 2040. Of course, that's far out in time, and we as Volvo have a much more ambitious strategy to get completely out of it in 2030. But I do believe it's good that industry players and authorities together have a discussion on when is it sensible to have the end of ICE, because at some point we need to end ICE if we want to get to a net zero by 2050. That's it's simple climate science.
Mm. And the fact that the European Union wants member states to stop selling combustion cars no later than in 2035. How important is that in order to really achieve this revolution?
Let's see, but I do believe you cannot achieve all the changes we want just with incentives. Sometimes we compare it with car safety. I mean, when people realized that the only way to save people in cars is actually a 3-point seat belt, it wasn't the government said that you get, €1,000 rebate if you buy a car with a safety belt. They basically said it's mandatory that cars have safety belt. And that drove the adoption very quickly. For certain features, that is a very good signal to drive an industry to make it mandatory. And I think having a requirement that there is no tailpipe emission wouldn't be a strange mandate from a government to put in. And I think the key here is not exactly when you put the date. I think it's key that you put the date, because then this becomes inevitable, and who wants to buy a car or invest into a technology it's not going to be fruitful in the longer run. So I think that could accelerate the transition. Mm. But our strategy is set regardless.
Yeah. Thomas Ingenlath, the CEO of Polestar, the EV manufacturer that you're still a very large owner in, he was very critical of the Glasgow Declaration. He said that targets were extremely unambitious and that traditional car makers are moving as slowly as they can in making the switch. What are your thoughts on that?
Yeah, I can't talk on behalf of the whole industry, but clearly the industry need to move quickly if we are to reach net zero for the society at large by 2050. We need to get out of combustion engines, and I agree that it's not going extremely quickly right now, but I look very much with positive eyes on the development, because I see the demand from consumers is there. the technology that enables the shift to fully electric is definitely there, and you see the legislators want it as well. So as with all changes, first they happen much slower than you hope, but then when they happen, it goes very quickly. And I think we are at that inflection point now. So I do believe that regardless of the lack of some of the declarations in Glasgow, the market and the consumers will drive this change very rapidly, at least in Europe.
At the summit, you also announced that you have introduced an internal carbon price of 1,000 Swedish SEK. That's about $110 for every ton of carbon emitted across the value chain. Can you explain how and why this new system?
No, it's as I said, we want to be climate neutral 2040, and then there's a million things we need to get right, and then every decision we have an impact on our CO2 footprint. And it's been a bit of a tendency that you have a sustainability team who's very good at counting the grams for any decisions, and then you have the, call it normal management, where you take the big investment decisions, and then you look at the regular things of profitability and what consumer thinks and impact on brand and so forth. And of course, that can't be two different things. It has to be one thing, because it's in those decisions that you build the sustainability for the future. And a lot of people speaks in US dollars rather than in grams CO2. And by saying that a CO2 abatement of 1 gram is worth those around $100 US, it's a way to put a clear cost on the CO2 footprint that you create with your decisions. And conceptually, it's basically that by 2040, we do see that there is a residual here. We can take away a lot, but there will be something left there. And then we need to have real abatement. Not that we buy some credits from somebody else, but you need, if it's carbon capturing or some kind of real abatement. And the assessment right now is that the cost of that abatement will be around those $100 per ton. So let's already now start to calculate for that cost that we inevitably will end up with. And I do believe that legislation will put taxes on it well before we get there. So it's good to start planning for it already now.
But $110 US, isn't that quite a high price at this point? What's the motivation for it?
Nobody knows. Yeah, nobody knows what the cost of carbon capture or abatement will be in 2040. And there are different people make different estimates of it. But I do believe the key thing is to put a number. And if it's 110 or 150 or 50, that's not the key point. The key point is that you get a dollar value for it. You get the discussions on sustainability in the same context, in the same room as you make your major economic decisions. And that's what we are achieving with this.
And speaking of costs, from the consumer perspective, in order to succeed with these ambitious targets, I assume it's to a large extent also a matter of pricing. And when do you expect the cost of producing an EV will reach parity with combustion engine cars?
So you're right. I mean, the car industry will become fully electric, and of course, consumer will not start to pay much more for cars just because they're electric. And likewise, yes, today some governments are subsidizing fully electric cars to some degree, but eventually, when the full market is electric, they cannot subsidize the market. So you need to reach a cost level parity for BEVs with ICE. And in our plan now, and the development roadmap we have, we will reach this full cost parity of BEVs with today's ICE by mid-decade, around 25. And the things that needs to get fixed is basically the battery cell cost, the whole electric propulsion efficiency. That's the key thing that we're working with in order to create that parity. And we have a clear plan on how we're going to achieve it. And up until that point, consumers are to some degree willing to pay a bit of a premium, and there are a bit of subsidies. So for us, this transition to full electric future is a profitable transition. Yes, it might have slightly lower margins in the first generation of the technology, but to grab market share in the growing part of the market and then get up the learning curve on the technology and take out cost is the right way to go if you want to be successful in the long run. And that's our strategy.
We've got another question from the audience. Have you thought about what tools, applications you can use to bring greater transparency to how you measure climate impact?
This is a question we're working with a lot. So the most basic tools we have is very simple. It's just to create a transparency in a waterfall measure in terms of here is the full over the life cycle CO2 impact of per car. What comes from tailpipe, what comes from our operations, what comes from the supply chain, and then basically all the initiatives and changes we're driving in the next, say, 5 years. What impact will they have on CO2? And we make a pretty simple waterfall that just clarifies how this will go down, and creating that transparency and everybody understanding that waterfall and keep improving that waterfall. That's the first level. And then the second level is then to make sure that all the controllers in our company, who is very good at understanding what things are costs in dollars, that they also get the basics and understanding the kind of full value chain effect of CO2 and start to put that into the exact same calculations. I don't want that to be done in a completely different system. I want all the controllers at Volvo to be able to speak CO2 as well as they speak dollars.
And moving over to collaborations, at Volvo Cars, you're collaborating with ISSB to develop fossil-free steel, and you also have a joint venture with a battery supplier, Northvolt, to produce batteries using renewable energy. Can you tell us something about that?
Yeah, maybe I take a step back and say the carbon effect footprint of a car today, or Volvo today, basically, it's 60% comes from tailpipe emission, maybe 30% comes from the supply chain, and less than 10% from our own operations. And of course, we need to fix all of that. So first step, make the car fully electric, then you take away the 60%, but you actually create a new problem, because then you need to deliver and build batteries. And those batteries, first of all, they require energy just to build them, and they require a lot of materials that, of course, consume CO2. So you need to develop those batteries in a very efficient way, and that's exactly what we're doing with Northvolt, to develop, first of all, put the factory in a place with fossil-free energy, and also to make sure you build in a high degree of circularity in the material you use, both how you source it, but also how you put it together so you can reuse it once a battery is old and it can go back to be material in a new battery. So that's exactly what we're working with together with Northvolt. And then, yes, so then we solve batteries, but then a car is still a big piece of material. You have a lot of steel and aluminum and plastics in it, and that requires a lot of CO2 to get produced. And especially steel has a quite big carbon footprint. And what we're working with ISSB to do is to invest in technologies, totally new types of technologies for developing steels, with a much lower CO2 footprint. And that technology we need to get at scale in order for us to get to this climate neutral situation by 2040. But we can't solve all of this by ourselves, but we can partner up with great and progressive suppliers and find the ways to get there. And that's the idea.
Collaboration is key. A final question. What has your own IPO meant for making sustainability targets reachable?
A lot. I think, first of all, going from having one owner to having 200,000 owners overnight is, of course, inspiring and interesting. And the whole strategy that Volvo was IPO'd on is a strategy of, reaching a fully electric future and reaching our sustainability targets. So I think it was a big vote of confidence for the strategy that we have, and also a big obligation for Volvo now to continue to report on the progress on what is the CO2 footprint per car. We're going to report that every quarter. So we got capital, and we also got a big vote of confidence that our fastest transformer strategy is something that investors believe in, and now really count on us delivering on. And I think that makes us even more determined to continue the journey we're on. And basically, we have no choice. If we don't, I think we're going to be really hurt on the stock market.
Excellent, thanks. We're unfortunately reaching the end of this session, so thanks so much for joining us, for sharing your insights on the electric car revolution, Björn. I think we'll be back shortly with Francie.
everyone. My name is Francine Lacqua. The big question we'll try and answer in the next 20 minutes is, what will a comprehensive global baseline of sustainability disclosure standards mean for the financial markets? I am delighted today to be joined by Erkki Liikanen. He's the chair of the IFRS Foundation Trustees to discuss the formation, of course, of a new international sustainability standards board and what is next for the standard setting journey. So, Mr. Liikanen, as always, thank you so much for giving us a little bit of your time. Now, whatever you think of COP26, the takeaway, of course, is at the intersection of the capital markets and climate was the formation of this international sustainability standard boards. What does it mean for the financial community?
The real challenge for climate change is that we need a lot of capital to the transition. You know, industry must go through enormous transition. It cannot be financed by public money. So you need investments. To be able to do the investments, of course, the capital markets need to know what is it worth, what will happen, what is the disclosure of these activities. And what we are working now on is to start to create transparent, comparable, sustainability disclosure standards. And that is big change. So we would know more. Investors can assess the information what companies will give in the future.
But Mr. Liikanen, first of all, how urgent is it that we get something concrete, and why did you decide to do this now?
I think that's a very good question. Let's say we have come to the mainstream. Earlier, climate issues were dealt with the finance ministers. Now in Venice and also in Glasgow, you had the finance ministers, central bank governors, even heads of state. So it's becoming the mainstream issue. But still, today there are so many different standards. It's very complex. It's the people speak about alphabet soup. You don't really know. The investors need to be able to compare and draw their own conclusions. This will be a big change. We will start from climate, but we will move on once we get the first standards in that area.
So end of 2021, how urgent is it to create these global standards? What do investors, as investors wait for this, actually, is there a danger that we have even more greenwashing that we've had so far?
That's exactly the point. I mean, if we don't have a transparent, comparable standards, the risk of greenwashing is very, very important. And now there are two major issues which have now changed. We have decided to consolidate the sector so that standard setters, major standard setters such as Value Reporting Foundation, ISSB, will merge with the IFRS Foundation. It gives clarity, already transparency, and that's very important. Second is also that we came out with a prototype. So what type of standard could it be in the future? Prototype is now available, so the markets, investors, anybody can study, because we will work on from that basis.
Where do you see the biggest challenge, Mr. Liikanen, arising in the formation of this global rule book on disclosures?
I think biggest challenge is now that we have two issues at the table at the same time, urgency and standardization. Normally standardization is a very slow process, but now we have urgency with the climate change. So this is something we have never experienced before. And we have tried to help it really with a lot of preparatory work from the summer on, so that once we get the nominations done, so we have the chair and vice chairs for the Sustainability Standards Board, we could have a running start. That's in standardization field, perhaps for the first time we do so.
To create a truly global rule book, do you think there will have to be compromises? So will we end up with something that's imperfect, but at least global? And is that better than striving to have something with more teeth?
Very justified question. I would say that we need one global baseline because climate change is a global issue. It doesn't stop at the borders, not even at borders of big jurisdictions. So this kind of global baseline, when we have Americas, Asia, Europe, Middle East, Africa, is critical. Then, of course, jurisdictions and countries who have higher ambitions, they can add up their own requirements. But it's very important these two are interoperable. So this global baseline would apply for all. And that's also what the markets need. I mean, capital markets are global. Investors move from country to country. They need to be able to compare. But this complementarity, the approach of, let's say, building blocks is the one we trust.
And Mr. Liikinen, I know it's still very early days, but how will this newly formed entity be able to shift capital markets and the economy into one that is cleaner and fairer? What kind of timeline and what kind of steps are you thinking about?
Let's say first, if we get the first standard next autumn, as I hope, it is a disclosure standard. So investors know more about the behavior of the companies. They need to disclose more, explain and report. Of course, that will have impact on the pricing. And through the prices, it has impact on the capital markets. And I think in that area, the trends can change relatively fast.
Can you give us a sense, and I know you've touched on this already, but where the lack of harmonization is very dangerous, or what part of the market will be more difficult to get everyone aligned?
I think that in political terms, we are quite happy that G20 countries welcomed this initiative. So we have broader global support for the work we have ever had. And now the question is that when we get this global standard, baseline standard ready, that also the countries will implement it. And I hope in the end make compulsory. Because of course, voluntary is important, market is important, but it's more powerful, of course, if it's also mandatory in countries.
So do you see, the EU, for example, supporting the ISSB or just focus on taxonomy and CSRD?
Let's say so that EU has said, especially their Vice President, Valdis Dombrovskis has said that they can't do this alone. You need EU, but you need the whole world. So they support this idea of this global baseline, but it's clear that Europe is here a leader. They are more advanced, so they want to build up their own requirements on that. So at the moment, really in the context of G20 countries, we have had all major economic and political powers supporting this baseline concept, and that's why we are quite optimistic. But really, we need to move fast, and that is new. And then when we have the standard, then how the different countries will start to implement, and the end, hopefully, make them mandatory is the story we need to follow, and we need many operators there.
Mr. Liikinen, I have a question from the audience, so everyone in the audience, please send as many questions as you want. We love having questions. We love hearing from you. So this person is asking, when will the ISSB have its leadership in place, and what type of leader are you looking for? I don't know if it's a job pitch or not.
It is a very, very good question, and we are just working with the nomination. I really hope that we could have at least the chair nominated by the end of the year. So we announced the ISB in early November, and now chair would be nominated. We need people who know financial reporting and who know also sustainability reporting. They are complementary tasks. There must be certain interconnectivity. So we need people with broad background. I hope we also have people who have really already experience on the sustainability work. And I know among the candidates that we have been able to attract great number of talents. But we must follow the proper procedures. And in the end of that procedures, we have at least chair, I believe, by the end of the year, vice chair soon, and then we go for the board. But let's say first quarter next year, we should be quite ready to be active.
Mr. Liikinen, I have another question from the audience. Thank you so much, Mr. or Mrs. audience member, for sending it in. The IFRS reported that the plan is to work with integrative reporting. And so this person asks, at present, many companies work with GRI. What will this look like in the future?
GRI will be a very important partner for us. Of course, let's say the difference is that the International Financial Reporting, International Sustainability Standards Board will focus on investor needs. So that's clear mandate for us. GRI has broader scope and broader audience. But of course, these can be very well complementary, and I'm sure we'll have a good dialogue also in the future.
Okay, and I want to talk to you a little bit more about complementarity, but there is a lot of talk, Mr. Liikinen, about a just transition, about a fair transition in general, and a pretty big acknowledgement that developing nations are coming in the transition from a positive or from a position of disadvantage compared to some of the developed markets. Should accounting rules actually take this into account?
I think somehow they must be transparent and comparable. And we have decided put that as a focus, that we have a major focus on developing emerging countries, and also have standards which can be applied also for smaller companies when they so want. I think we must look at this issue in detail, but this kind of able to apply in all circumstances is critical. But in general, of course, the whole climate change has a problematic distributional impacts. I mean, I just have seen studies who see that, for instance, carbon tax, which according to the economists is one of the key instruments for the solution, and most efficient ones, it has, for the distribution, negative impact. So policymakers must handle many issues at the same time. But it's not something standardization can solve.
No, I was going to say, how do you model that? It's very difficult to actually make something that, is fairer, comparable, but different.
Yes, of course, but our task is more limited, because what we want to do is standards so that the companies need to disclose all essential information in this field, and then investors can, from that basis, price their own investments. But of course, distribution impacts are very important, but they are more for policymakers who are mandated for those issues.
As you're looking at critics, some critics say that at the end of the day, the ISSB is another voluntary standards setter with no enforcement capabilities. So it's just a lot of talk, and we don't really know where it goes. How do you respond to that criticism?
I don't believe so. I said already earlier that this climate change issue has come to the mainstream. People want to see action. They want to see change. In that area, of course, we must move step by step. First, have a standard. Then IOSCO, which is the International Organization of Securities Commissions, will analyze its applicability. Then it goes to the policymakers who think about making it mandatory. Then also, let's say, auditing business is important, because they need to analyze whether they have been properly applied. I'm quite convinced that this chain will be more efficient than people expected today, because of the commitment really of policymakers in all levels.
So I know, the ISSB is meant to encourage the uptake of standards globally. Could you give us a little bit of an idea of what this encouragement could look like?
Can I just say that first we have decided to make ISSB a different type of organization. IFRS, which is International Financial Reporting Organization, is based in London. So it's one place, and our main staff is there. We have one office in Tokyo. But because sustainability is different global issue, there are many, let's say, elements which are sensitive politically. We have wanted to make it a global footprint. So already we have decided that we have the office for this standard board will be in Frankfurt, where the chair will be sitting, other one in Montreal, and third will be in Asia, so that they are present in the field and they are there to inform and also mobilize people. At the same time, it's consolidation, where we have consolidated voluntary initiatives in that area with the IFRS Foundation. It means that we have presence also in Americas, and we are in that area. So we try to make this global presence very strong, because then we're able to act throughout the globe.
And of course, this will depend on regulators, but how much does it depend? How much does your strategy also depend on government?
Of course, let's say now we have got we can act for the standards now. We have got the support for G20 countries. We will move on. Now, I must say also that many governments have been ready to invest in seed capital. So we have resources to move on. But of course, in the end of the day, the commitment from the governments is critical if you want to make this mandatory. And we also need, as I said earlier, we need also audit profession, which give assurance whether they have been properly applied. So all the public authorities, regulators are needed. But it's so different compared to what it was 20 years ago. I was 20 years ago in the European Commission when we created IFRS standards. And EU started to endorse those. At the same time, Kyoto Protocol was signed. But these two roads never met. We're totally separate ones. Today we talk about financial reporting and sustainable reporting at the same time. I try to find their complementarities in that area.
Can I just ask you a little bit more about, this idea of encouraging? How do you encourage? How does, if this picks up, does it automatically encourage other companies, or is there a snowball effect? Is there pressure points that you could put in place?
Of course, with communication, we can put pressure, but I'm sure that investors want to know more. And I mean, when we made this proposal known in early February, in early March, there was a big relief in the investor community that now finally something clear and more transparent happens, because they need these tools. And when investors ask companies, and if they say that we are not able to properly report, I think it is a terribly disincentive. There will be a premium which this will cost. So I'm sure that markets will push forward. We give the tools to make it simpler and clearer.
I mean, another question that's coming in is, what kind of feedback you have been hearing from companies and investors since announcing the ISSB? So you were just talking about some of the companies asking things before the announcement in March. Are they concerned about the timeline? Are there any specific requests by companies to formulate it in a certain way?
Not really. I must say what has helped us is the Task Force for Climate Disclosures, which has made a major report a few years ago. And many companies, many governments are supporting. We start from there. We have made prototype on that basis, and that will be basis for the work which will lead to standard. So companies have been involved. I would say that investor world has been very much supportive and pushing us to go forward. When we made the announcement, this International Sustainability Standards Board was very much expected. But what surprised the markets was that we were able to have a solution to this alphabet soup, have simplicity, clarity, major consolidation, and that has been very much welcomed. Perhaps I must say that for the announcements, more happened than people expected. But now it's more important, of course, that we act and we surprise positively also in that direction.
I understand, you've laid it out very simply and very articulately what you're hoping to achieve. But is there something that you think the ISSB will be capable of solving, concretely? Is there a problem that you see right now in ESG that you think will be fixed in the next 24 months?
I think that on the climate standard, we will be able to do it. So that there'll be first climate standard, I hope, this time next year. And then it means that the companies, when they report, they use that standard as the basis. And investors require information which comes from that basis. I hope we have also able to accept the kind of presentation standard, how all these standards will look. Beyond that, once this is done, of course, then we need to move forward in the areas where there's a strong demand, social governance. There are no simple issues there either, but I'm sure that we must learn from the experience and also go broader areas. But it's demand-driven. I just want to say that we did not look for new mission. We didn't fish for new tasks. It's been very strongly demand-driven, and that gives us also strong justification.
Mr. Likin, I have another question from the audience, which basically is asking, how will the multi-stakeholder expert consultative committee work on the building blocks approach across jurisdictions? And is this just with governments or broad stakeholders like investors?
The multi-stakeholder group mainly includes international institutions who have been active in this area, like United Nations, OECD, and the others. But of course, we are careful also to include for instance, civil society in the discussions. There are places and opportunities for civil society to participate, because we need investors, because it's investor-driven, it's investor demand. But today also the citizens, civil society, the NGOs has huge impact also on the preferences of the people, and they have impact on the market. So we need to be able to also include them into dialogue.
Should we be expecting more consolidation? So GRI, CDP, beyond VRF and CDSB being absorbed, are we going to see things come together more?
Now, GRI has a different scope. So they do important work, but they are focusing to the multi-stakeholder area. But now with these solutions, we have the basic solution for investor, for those companies, for those organizations who have investor focus and who focus on the enterprise value. I think we need to get this consolidation done now. It's we have announced it, we have agreed, but we need to make it work. And let's see it beyond that after we have implemented this whole.
How does the ISSB relate to other initiatives like TCFD or SASB?
TCFD is a very close partner. They have been working with us a lot and supporting us. And when we are doing this prototype, which like really first phase basis for new standard, TCFD has been a very good partner, and we have benefited from the major work which we did during the years, and also from their support this on.
I mean, someone's asking actually, do you plan to use a Bloomberg model task force for the IFRS climate disclosure standards?
Let's say that their recommendations, which they made, are important part of information which we will use when we work for the standards. And the prototype, which has been really public now, is based on those recommendations.
I have another question. I love engagement from the audience, Mr. Liikanen. Will institutional investors, such as foundations, be included in the stakeholder community, providing information and perspective of use to IFRS?
I'm sure we will find many ways for dialogue with all the institutions who are interested. I don't want to define the limits of bureaucracy, what we need to build up, but we will be very open. We need their advice, we need their support in this work, and I'm sure we see often in this long path. And many institutions have done, and foundations worked for a long time in this area, and they will not give in now because we have more progress.
Well, we're almost out of time, so let me go back just to the timeline. Once you have the standards in place, how do you convince companies and others to actually use them?
Let's say, of course, if they become mandatory, then they all need to do it. But I'm sure that before they are mandatory, there will be strong pressure from the markets. Investors want to know more, and when standard is there, they require information which is based on these standards. So this market-driven process, market-led process will be very strong. And I hope relatively soon also they will be made mandatory.
Do you think in terms of the framework, because, and we were touching on that right at the beginning of the interview when we're talking about Europe and regulators and whether they'll adopt some of the standards that you'll be putting in place, does the European framework end up becoming some sort of global benchmark because they've been spearheading this, the effort sooner than everybody else?
I must say we must give a lot of credit to Europe because they have been really leading in many areas. But climate change is a global problem. We need to have a global baseline. I mean, if we don't have Asia with us, it's a major problem. And for that reason, especially today, we work very much with all continents, also with Asian institutions, Asian organizations, so that they are part of this big effort. So Europe is important, they saw direction, but the problem is global and solutions need to be global.
So this person's writing in, where will ISSB be located?
The ISSB will have 3 locations. So now the seat of the board will be in Frankfurt, and the chair will have office there. But equally important will be Montreal, which will focus on the Americas, and they will have also major activities. And third, we will also locate one office to Asia. And it's clear that Beijing and Tokyo will be mentioned in that context.
Mr. Liikanen, a final question. When you look at the stratospheric rate of growth in the ESG market, I think we're looking at $35 trillion in last year in total assets. That's according to Bloomberg Intelligence, and then more than 50 trillion by 2025. Does that give you pause? Is there a risk that actually these numbers are inflated?
There is a risk, of course, and I must say that if there's greenwashing, there'll be also disappointments. And for that reason, I think that faster we move on the basis of the standards, which are comparable and verifiable, better for the whole business. So let's hope that we avoid any major tragedies there, but It can be only avoided in the long term when we have transparent, comparable standards with metrics.
Mr. Liikinen, thank you so much for your time today.
Thank you very much.
With the agreement in Glasgow signed, it's perhaps worth pausing to consider some of the common ground found. The primary focus was rightly on simple carbon emission reduction. But there were two other developments which gave particular cause for hope, on natural capital and on carbon markets. The emergence of natural capital as an investable asset is a powerful new tool in the climate battle. The concept dates back decades, but it's only today that its potential to combat global warming is becoming more widely understood. Most attention has been on how the world reduces emissions. The role nature can play has been less well appreciated, although Sir David Attenborough has been its greatest advocate for many, many years. However, nature's raw potential can only be really harnessed if its true value is recognised and accounted for, and here asset managers can be a catalyst for change. The Natural Capital Investment Alliance, launched by His Royal Highness Prince of Wales at COP, is an important step on that journey. The 15 members of this group are focused on channeling capital into nature-focused projects. That's what's needed. To date, philanthropy has been the driving force, but their reach is inevitably, it's quite limited. Imagine what more could be done if those projects could attract not just generous support from donors, but from investors too. Even if a tiny fraction of the $100 trillion managed by asset managers around the world was channeled into natural capital markets, it would make a really powerful contribution to mitigation efforts. For it to work, investors need a viable and sustainable set of returns. And in this regard, it was the second development that was of note. Carbon offset credits are increasingly being used by governments and companies to mitigate their footprint and help the transition. The value of traded credits this year will likely surge to $1 billion, but there's much, much more still to come. But more work is needed to unify these markets behind a consistent set of values and a set of standards. And now that work is happening. It's being led by Mark Carney and Dame Clara Furs, and the City of London has a really important role to globalise this market. This would really help breathe life into the pricing of natural capital. Projects that enhance biodiversity and benefit local communities, not just absorb carbon, would deserve a higher grade of carbon credit. And demand for premium credits would likely grow as the potential for returns became clearer. And that becomes the virtuous circle that we need to get into. For our part, we've worked with Natural Capital Research and Oxford University spin-off to develop this capability. Because we can't forget that, after all, that our primary responsibility is to savers. It's their money and their pensions which must be invested to achieve the best outcomes, both for their future and for societies and for climate. If sufficient scale can be achieved with the creation of natural capital markets, it will attract yet more investment, and support from the wider asset management community will inevitably follow. Now, none of these measures will solve the climate crisis alone. We know that. Investment in nature and carbon credits cannot be a substitute for rapid and deep reduction of each company's emissions. However, they can, and really can, help increase the likelihood that agreements made in Paris and in Glasgow are actually met. I'm excited by the potential for free markets to offer a step change in nature conservation. They've often rightly been the object of climate debate criticism, but the raw power of what could be unleashed could act as a really unifying force in helping cap temperatures at 1.5 degrees above pre-industrial levels. And to my mind, it's just one example of how our industry can move beyond profit. A quiet revolution in environmental investment is starting. It will make a real difference. It's been a great privilege to be at the Bloomberg Sustainable Business Summit. I hope you have an exceptionally interesting and worthwhile time. Thank you.
Thank you, Peter. I'm Lauren Keel, the General Manager for Bloomberg Green, and I'm thrilled to be joined today by Dr. Carolina Mineo-Paluelo, the Global Head of Product Solutions and Quant at Schroders, and Dr. Becky Wildbohr, Head of Research at Natural Capital Research, for Schroders Advisory Board Spotlight on Harnessing Natural Capital. Welcome, Carolina and Becky.
Hello.
Carolina, I'd love to start with you. What is the importance of natural capital to Schroders? How significant is this new relationship that was announced earlier this year?
Natural capital is very important for Schroders because this new and emerging asset class is critical in a journey to deliver net zero and really meaningful environmental, climate, and social impact. We're working very closely with our clients to build solutions that contribute to the climate challenge. We build portfolios that contribute, that support the climate transition, that support the climate mitigation. This is important, but this is not enough. We need to go further. We need to think about climate conservation. What do I mean by that? I'm referring to investing and restoring our carbon sinks. And that is why the collaboration, the partnership with NCR is so important, because we need tools to assess the carbon storage, the carbon sequestration, the biodiversity, and that is exactly what NCR has done.
Becky, tell us more about NCR. Tell us a little bit about the history and these focuses on biodiversity and carbon capture that Carolina mentioned.
Sure. So we set up Natural Capital Research in 2018, really born out of a desire to show what good looks like when we're trying to understand natural capital in quantitative terms. So we set it up with Professor Kathy Willis and Professor Dieter Helm, both based out of Oxford. And really, we're a data-led, science-based organization. So what we offer to people is an understanding of both the quantity, the quality, and the spatial configuration of their natural capital. When we're talking about natural capital, we're thinking about it in terms of assets. So as an asset manager, really what that means is, how much forest do you have? What water bodies do you have? How is the soil, the topography, the species? And can we quantify that in a way that helps you to really understand where you are now and what are the opportunities for enhancement? Then we also look at the benefits that we derive as a society from the environment. And by quantifying them, we can make better decisions about them. That's really our aim. We're very data-driven. We use machine learning and AI to understand these things at a small scale and work with landowners on a small scale, but also think about these things at national and global scales as well.
And Becky, how does NCR's work support clients?
We launched a tool in the UK about a year ago now called NatCap Map. And the way that works is to help landowners, but also local authorities, charities, water companies in the UK, to understand their natural capital and to easily and quickly access a baseline that tells you where they are now in terms of the quality of their natural capital and the opportunities for enhancement and improvement.
And I guess that is where, as they work with you, they realize that, of course, there is an opportunity to improve, but they may need support, financial support to do that. And that's where I would say we are coming in with the ambition of directing capital to really get those projects and this improvement done and really improve carbon storage and biodiversity.
Indeed. And the exciting thing about this partnership is that we can then take this tool globally as well and offer those same services to a wider range of clients.
Exactly.
And Carolina, tell us a bit more about how investors can harness the opportunities in natural capital.
This is a very important question because natural capital typically has invested in activities such as timber and farming, where the income was mainly driven by harvesting. But today, there's actually a new source of income. And here I'm referring to the sale of carbon credit. Effectively, carbon credit are earned through the sequestration of carbon and then subsequently sold. So this is a new and additional uncorrelated source of returns for our investors. And actually, in addition to forestry and agriculture, there's also conservation projects that are becoming very interesting. Up until now, they have been uninvestable and really reached only by funding from philanthropy. But they are now piloted to demonstrate that financial returns can be achieved by the voluntary carbon market.
Carolina, Becky, thank you both so much for joining me, and thank you to Schroders for this advisory board spotlight.
Thank you.
Thank you.
Hello, everyone. Thank you so much for being here today. My name is Mallory Ritigliano, and I'm a Green and Sustainable Finance Analyst at Bloomberg NEF. And I'm joined here with a fantastic panel of experts on the topic of ESG and climate-related disclosures and standards. We're going to have a fantastic and interesting discussion today. Now, before I go into their introductions, just to set the scene a little bit, a lot of us have heard about the ways that companies and financial institutions and governments as well are pushing for more data transparency, more ambition on targets such as net zero emissions targets, and setting goals that are material and meaningful for a transition. And so we're going to be talking about a lot of interesting topics today. I'm joined by Ravi Abewardana, who's the Technical Director at the Climate Disclosure Standards Board, or CDSB. Also with Alex Bernhardt, who's the Global Head of Sustainability Research at BNP Paribas Asset Management, and Megan Starr, who's the Global Head of Impact at Carlyle. So before we hop into questions, I just want to give a quick reminder to those in the audience who are joining virtually that if you have questions, we're going to try to get to some Q&A from the audience at the end if we have time. So type your questions into the white tab on the right of your screen, right of the video window, and then hit submit when you're ready to submit your question, and we'll try to get to them at the end. There's a lot of interesting discussion to be had, and we definitely want to know your thoughts and questions. So to hop right in, I'll start with you, Ravi, put you in the hot seat for a second. CDSB is, a provider of a framework that aids companies in setting environmental and climate-related disclosures as a part of their, regular process for reporting. So one thing that I wanted to ask you, since certainly you're not new to this space, neither is CDSB, how has this landscape changed in a meaningful way over the past few years as we hear much more about disclosure, transparency, but even longer than that, even perhaps the last decade, what are some of the most notable developments that you have seen in your experience?
Yeah, of course. And thank you ever so much for inviting me here today. It's a real pleasure. So with regards to the big shift that we've seen with regards to ESG disclosures, I guess the release of the Task Force on Climate-Related Financial Disclosures, also referred to as TCFD, and their recommendations published in 2017 really propelled the thinking of how climate can really pose a risk on a company's financial position, performance, and the execution of its strategy over the long run, very much complementing what Mark Carney had referred to as the tragedy of the horizons, where financial markets companies are very much focused on the here and now, but not really considering those potential business risks and opportunities from such matters as climate. So that thinking really got the backing of investors, and you can see in a handful of jurisdictions to date that they're looking to actually mandate such thinking around climate-related financial disclosures, which is a really exciting move. I guess off the back of that, you have the recent announcement by the International Financial Reporting Standards Board, IFRS, and the establishment of the ISSB, which stands for the International Sustainability Standards Board, which very much uses the building blocks of TCFD, but it looks at the entirety of sustainability issues that could pose a threat to enterprise value over the short, medium, and long term.
That's really good to know, and thank you so much for kind of spelling out the steps that have been taken, Ravi. And for audience members who are maybe slightly newer to this world of disclosures, as you can see, it's a world of acronyms. So we're going to be delving into a lot of different terminology and acronyms today, but thank you so much for that Very thorough explanation, Ravi. And on that topic, that's a perfect segue into one of the things that I wanted to cover today. And I'll jump over to you, Megan, if possible, to talk about sort of that coalescing that Ravi was just mentioning, right? The bringing together of experts, initiatives, science-based standards under an umbrella to try to streamline and improve transparency even more, which is sort of what disclosure is all about. So turning on that topic of convergence, I kind of wanted to get your opinion on where you see this playing out in terms of improving the flow of the ability for companies and financial institutions to disclose in a meaningful way, but also inertia that it may provide. How does data convergence play a role in how we're able to disclose, and then how we're able to make action items off the back of that disclosure?
Thank you, Mallory. I would say data convergence is one of my favorite topics. So excited to chat about this. So I'd say we see three main trends around ESG data and disclosures that have really ramped up in the past year. First, we've really moved away from binary metrics to more quantitative metrics. So instead of do you have a diversity policy and do you disclose it, what is the actual makeup of your board, C-suite, broad workforce? Second, we've really seen a focus on saying, how do we look at change over time versus static state? Because a single data point at a single point in time doesn't tell you if it's a good company, if it's a bad company. We need to know relative positioning intra-industry, and much more importantly, we need to know that trajectory, because what matters is where companies are headed, not where they necessarily are today. And then the third piece is around convergence. And I think one of the challenges we have in the ESG data and disclosure space is that in pursuit of our overall goal, which is a set of meaningful, performance-based, comparable data, we have been running in 1,000 different directions, and we have framework fatigue. When I talk to our portfolio companies that want to start doing sustainability reporting at Carlyle, my recommendation sounds something like start with GRI, then do WEF, and then SASB, and then TCFD, and CDP, and the SFDR, and maybe the SDGs. And that's the best answer. So we've been a part of a group called the ESG Data Convergence Project, which launched this September. And the idea is this is not a new framework. It's not a new standard. It's a group of private market GPs and LPs who have come together to say we have to converge towards a smaller set of more meaningful data points where we can get critical mass. We have 92 GPs and LPs that have come on board, representing data from 1,200 private companies for 2021. We've all agreed to track just 6 ESG metrics using the exact same definition with the same financial normalization metrics to make sense of the data, to aggregate that data centrally to create the first private market ESG benchmark. That excites me because we all need to roll up our sleeves and work together if we're actually going to converge towards performance-based data.
That makes a lot of sense, and the concept of trying not only to get more data, but also to make it usable is, I think, something that has become a more recent barrier, right? Like the first hurdle is get enough information to say something meaningful. The second is to parse all that information to say something meaningful. So I think that's a fantastic point on data convergence, and leads me into my next question for you, Alex. That's a perfect segue as well into the topic of what data points do we still need, normalizing and creating measurements and standards for how we are going to handle data and make sure that we're using it to reach ambitious targets is one part of the picture. But another is what metrics do we actually still not have that we do need? If we're sort of on a question of, are we there yet? We all certainly know we're not there yet. We haven't reached something like net zero or alignment with different types of temperature targets, but we do know that we've made great strides. So what are some of the, at least in the asset management space or writ large, some of the data barriers that we are still facing, in addition to those about data management and convergence that we've already touched upon?
Well, it's a great question, and I will try to answer it in the context of a specific example. And you mentioned net zero, and I think that's a really interesting frame, because we're now at a point post COP26, which was the recent climate meeting, with the various national governance from around the world meeting together to try and negotiate around how we're going to reach a possibility of net zero climate emissions by 2050. And what we saw there is that there's $130 trillion worth of investors, banks, insurers, asset owners of various types have committed to what's called the Glasgow Financial Alliance on Net Zero. And in the GFANZ initiative, that huge wealth of assets is now committed to align with a net zero future, again, which means zero carbon emissions by the year 2050, roughly speaking. In order to get to that point, we have a lot of work to do collectively as a financial services community, and a lot of it really depends upon less upon what we do in our portfolios and our portfolio construction, and more on how the real economy transitions. And so, in order for us to really track our progress against these net zero commitments that many of us have made, we need to be very clear and transparent about what we're doing to both affect change in our portfolios and affect change in the real economy. And one of the data points that is becoming much more popular in sort of helping asset managers and asset owners and the like comply with their net zero commitments is what's called implied temperature rise, or ITR, measurement techniques. And these are the kinds of measurement approaches that produce a temperature value as the outcome. So this company or this portfolio is 2.5 degrees aligned is a common reporting that you'll see. Right now, as you see with a lot of new indicators, there's a panoply of approaches that are coming into the marketplace. Almost all of the major ESG data vendors have developed their own approach. Many asset managers are developing their proprietary approach. And I think this sort of innovation and diversity is really valuable. However, what we're doing right now is building these ITR frameworks on a fairly shaky foundation of information. So the key building blocks of any ITR methodology are carbon emissions, both historical and projected, where projections are provided, and then a climate scenario or science-based scenario benchmark. And in all of those cases, so historical, projected emissions, and climate scenario benchmarks, there's nothing that we can call standardization. We have carbon data disclosure has definitely increased over time, and the formerly the Carbon Disclosure Project, or CDP, has gathered a ton of information about carbon from corporations, but on a voluntary basis. And while that data has improved and increased over time, it isn't audited typically. It isn't validated or standardized in any meaningful way. And so what we end up doing in the community is, we license information from data vendors, or we gather the data ourselves and do adjustment techniques to try to make sure that data is smooth or more accurate, more reflective of reality. And the same thing holds for ITR. We're using this sort of I don't want to be too disparaging of it, because it's really important, and we're doing a lot of really important analysis on the back of it. But there are flaws in the data as it's disclosed. And so I think there's a real potentially important role for regulation to play in sort of increasing disclosure of carbon in particular as a key metric for all of us as a society, and particularly the financial services community, as far as I'm concerned, to make sure that we're holding true to our net zero commitment. So that's one of the metrics that comes to mind as an evolving area for us to pay attention to.
I'd like to just could I just come in on that? So I think what the IFRS is trying to develop here is this global baseline of clear and consistent information, and just really building upon what one of the panelists had just mentioned. I think there's a genuine need for that, so that jurisdictions can very much implement these standards and allow companies to actually follow those standards, and for them to actually be audited, because it's often the case that a lot of this information, when it is pushed into the public domain, is missing that a third party review, which can lead to some obscurity of the realities of what's actually happening on the ground.
That's a great point as well. And thanks for bringing that up, Ravi. And thanks for your points as well, Alex. If we're talking about things like temperature alignment, 1.5 degrees or 2 degrees, these are great examples of using science-based tools in order to benchmark and understand where we are and where we need to go, which is, basing in science is a very critical thing to achieving any type of climate goal. And that's why we're all here today, right? We're talking about data and disclosure, and that's what it's all about, getting that information. So on that point, we also talked about, or Alex, I think you mentioned data flaws and data gaps as well. And certainly, Ravi, your point about second-party reviews and sort of external certifications or checkmark exercises is a really great way to make sure things are getting more standard, that people are following minimum levels of rules or regulations. And on that point, I wanted to ask you, Megan, about how would you go about recommending what next steps are in making sure that we are in a meaningful way disclosing Scope 3 emissions? Scope 3, for the audience, being indirect emissions from things like supply chain, but in most directly here in our discussion, we're talking about financed emissions from investments and financial activities, which is sometimes, or almost always, the most difficult to calculate and to actually figure out where we are and then how we're going to mitigate it, because it's more levels removed than a Scope 1 or Scope 2, which is more direct emissions from an institution. So in terms of Scope 3, how would you deal with that in the investment space, Megan? I think we all kind of are struggling with this question right now. How do we deal with Scope 3?
Sure. I think it's clear to all of us that the world is going towards net zero because we have to head towards net zero. And we've already seen that over half of global AUM, investor capital, is under net zero commitments. 70% of global GDP is under net zero government regulations. And so we see that in the investment community. But I would say there is an easy way for investors to go net zero, and there's a hard way for investors to go net zero. The easy way, I like to call it portfolio magic math. If you're looking at the portfolio level and you want to significantly reduce your carbon emissions, you divest companies. So at Carlyle, we have about 250 companies globally. If we divested, call it a dozen companies, we could, on paper, reduce our emissions by about 95% without changing a single molecule of carbon in the atmosphere. And so I think we need to be really careful when we're talking about net zero commitments, that we're not talking about portfolio construction necessarily. So that's kind of the easy way of going net zero. The hard way of going net zero, and this is a little bit what Alex was talking about, is setting individual companies on decarbonization trajectories, because that is the real economy and that's what we can measure over time. So in terms of investors and helping portfolio companies get on decarb trajectories, there are a lot of tools we found to be really interesting. One I'll call out are ESG-linked financings. So for example, we have a portfolio company called Nobian, which spun out of Nourion earlier this year. And as part of that transaction, we did 1.6 billion euros of ESG-linked debt. That debt was directly tied to Nobian's goal of a 50% carbon emissions reduction by 2030, carbon neutrality by 2040, and renewable energy purchasing goals. The cost of their debt is tied to them being able to achieve those goals. And so I think this way of finding innovative ways to structure into financial transactions, individual company decarbonization pathways, that's how the investment community can really drive change versus doing the high-level accounting, which is relatively easy to do the math on to make it look like a significant carbon emission reduction without really changing what's in our atmosphere.
And I might add to that too, and I'd say in addition to, I think that's a great idea, Megan, and I think that one other thing that we've been pushing on in terms of trying to elicit real economy change, not just portfolio change, which I'm totally aligned with you on, is the engagement channel. Where I think BNP PAM is a bit different from Carlyle and what we invest in. We're very much focused on public markets investments, that we do have private markets as well. And we have a very large 13,000 plus company universe that we look at from a sustainability standpoint. But in that universe, in the publicly traded equity component of the universe that we invest in, we do engage with a number of companies, and a couple of examples which actually link well with this climate topic and the disclosure topic, which I'll cite. We filed resolutions last year for a couple of major high-emitting companies in the U.S., asking them to disclose their climate lobbying expenditures, which are currently opaque and not well disclosed. And on that basis, our goal was to shed more light on where they're talking, advocating against a net zero outcome, where they might be saying they're aligned publicly with a net zero outcome. They may be behind the scenes advocating against it through lobbying channels. And it's that kind of information that can really open a window to more action in the real economy and changing the corporate trajectory. And so, baby steps. It may sound like baby steps, and certainly it is, but it's a channel that we can control and that we can have influence over as investors by being more aggressive with our engagements on these topics.
And I would like just to add the opportunities there are for corporates within this space, because disclosure. I used to be a preparer for a global commodities company, and internally completing such disclosures is very time consuming. And for the finance people within business, it's often where's the connection. And what both Megan and Alex have just mentioned are the connections back to finance. So these are genuine working capital solutions on the transition to a net zero, economy, which we all want to, move towards. So you've got various different financial products out there for companies who do disclose, or their ambitions, and help them transition this via, pretty attractive working capital solutions.
That all makes a lot of sense, and what all three of you have mentioned. And I actually wanted to turn back to you for a second, Ravi, on that topic, because I think the points made about things like sustainability, linked instruments, financing that's actually incentivizing good environmental or ESG, environmental, social, and governance behavior, or disincentivizing not meeting targets that companies are setting, is a really great way to sort of reimagine how targets can be meaningful in the financial sector. But also, setting targets doesn't necessarily mean they are meaningful, and we have to go back to that data and disclosure to find out what is material, what is ambitious, and make sure that it's based in science. So on that great point that was brought up by Megan and then Alex and Ravi, I wanted to ask you, what role do groups like CDSB or non-governmental sort of voluntary standards and framework setters have to play in making sure that whatever creative instruments or strategies that are really necessary and are being taken are still keeping ambition and science as top of mind as they're delving into these new types of products and strategies, which are great to experiment with, but making sure that we know what is useful in the long term in terms of materiality.
Yeah, of course. I think that from my personal perspective, is that we're trying to move away from the beauty parade of sustainability disclosures to real meaningful disclosures from companies. So they're fully embedding this sort of thinking within their governance processes. So how they actually look at how are they managing this, over the foreseeable future, with regards to climate and other sustainability matters, which pose a risk to investors' returns over the long term. And those risks very much tie back to, companies meeting targets and the like. So it's really important that, companies do really consider these sort of such thinking from a voluntary perspective. But as I mentioned earlier, I think what you're seeing is that quite a few of these voluntary disclosures are being consolidated by larger organizations who are well adept to producing standards that jurisdictions can mandate. So the IFRS mandate is used by over 140 jurisdictions from a financial reporting perspective. They're looking to do the same from a sustainability perspective too. So producing standards which meet investors' expectations for clear and consistent data on sustainability matters, which pose a risk to their returns over, the short, medium, and long term, and they look to do that in a very independent way, so that jurisdictions can very much, lift those standards and apply them within their jurisdictions and mandate them to create that really consistent and comparable information, which we're really aspiring to. Going back to the ill of greenwashing and trying to actually address that appropriately, so that companies are communicating meaningful disclosures. And just going back to the IFRS has just consolidated my organisation, the Climate Disclosure Standards Board, as well as the Value Reporting Foundation, which comprises of ISSB and the Integrated Reporting Council. So there's a real convergence within this space, which is focused on enterprise value.
That makes a lot of sense, and I'm glad you touched on the topic also of different jurisdictions and regulation, because you mentioned earlier things like mandated TCFD reporting, and we're seeing this crop up more and more in space and in time, and knowing how that interplays with these voluntary standards that have been around for a longer period of time but are less, say, binding or mandated, is a really important consideration. As I see this as sort of being in three phases: things like ESG or climate disclosure or any topic like that, kind of goes from being fringe to being trendy and then to being really ambitious and streamlined and funneled down. So we're kind of in that swelling up period, in my opinion, before we can funnel down and make things that are really ambitious. And I think we're already on our way there. We're certainly not fringe anymore in the ESG space. But for the last 3 minutes or so, I'll just hand over to one question from the audience. It's not directed to anybody in particular, so feel free, whoever has an opinion on this, to jump in. The question is, and thank you to the audience for submitting questions, is how can we have better metrics to measure impact on biodiversity, which isn't something that we've talked a lot about today, but is definitely tied to climate and many things that are top of mind for people.
I'm happy to give that a start if you guys don't mind. We produced our biodiversity roadmap at BNP Paribas Asset Management earlier this year. And in it, we included a number of analyses which we attempted to conduct on our portfolios, looking at water risk and forest risk and things of that nature. And I think the asker of this question probably is aware of this, but the coverage rates that we had in our analysis were super low, sub 20% on our universe in some cases, in part because there's very limited disclosure about these impacts, and also assessment of them can be challenging. And so to address this, one of the things that we've done is we've partnered alongside other asset managers with a novel data vendor called Iceberg Data Lab to try and initiate a new data tracking measure, which uses input-output modeling and other unique techniques to try and scale a biodiversity-related measure for different businesses based on their sector and region of operation. But it's that sort of innovation which I think is going to be needed in the interim until either voluntary disclosure on biodiversity ramps up significantly, similar to what we saw on carbon over the last decade or so, or until there's a mandatory requirement from a regulator. And so we're working on those sort of novel R&D approaches now behind the scenes, but definitely we need more disclosure. And one thing that will help with that is also linked to physical climate change risk assessment, which is an emerging topic of increasing interest now that we know from the IPCC that we're heading towards a 1.5 degree future no matter what we do at this point. Which is the best case outcome we can hope for. And even in a 1.5 degree scenario, there's a lot of physical change that we can expect and that we need to adapt for and prepare for. And so I think the next phase in analysis will be
just one thing. From a preparer perspective, I would definitely suggest absorbing the application on biodiversity from CDSB. It uses real-life examples of best practice disclosures on biodiversity. So use that as a starting mechanism on companies who have taken the first steps on disclosing impacts on biodiversity.
To be a little bit controversial, I don't think we can solve biodiversity if we don't solve climate change. And I think sometimes in the ESG space, we can really stumble over our own feet and go down rabbit holes on topics that are vitally important, like biodiversity, but that get us away from the fundamental imperative of transitioning our economy. And so I would say just in general, we like to skip ahead to the end and are focused on perfect. And I think we need to be focused on progress because we have to focus on climate first if we're going to have any biodiversity.
Those are fantastic points. I want to thank you all so much for ending on such a strong point and just keeping it strong throughout the entire discussion. I know I was fascinated by all of the things that were going back and forth today, so I'm hoping that the audience felt the same. And thank you so much for your questions. I really appreciate it. Thank you, Ravi, Alex, Megan, and everybody who joined, and have a wonderful rest of the summit.
If you've been here at COP26 for any amount of time, you've probably heard the mention of methane. Last week, we got a pledge, the Global Methane Pledge, which the US and the EU put together with 100 countries pledging that they would cut emissions by about 30% by 2030. Just before coming into COP26, G20 for the first time, the 20 countries that account for about 80% of global emissions, said that they recognize methane is a problem and that they will do something about it. Now, why are we suddenly talking about methane? Let's look at the numbers. This might be a familiar chart to some of you. It's going back all the way 800,000 years. If we look at a chart that is about carbon dioxide, that's what it's going to look like. Largely remaining within a certain amount and then suddenly shooting up as we start using fossil fuels. Methane has done the same, but there's a difference. The amount of carbon dioxide in the atmosphere is about 50% higher than the 800,000 year average that we've had. Methane, on the other hand, is 150% higher. And we care about methane because in the short term, it has a huge warming impact. In the first 20 years of its life, methane traps about 80 times as much heat for the same amount of carbon dioxide that's released in the atmosphere. Even 100 years down, the amount of methane heat is about 30 times as much as carbon dioxide. Now, notice carefully here, the size of methane is decreasing as time goes out. And that's probably the good news, which is methane degrades much more quickly in the atmosphere than carbon dioxide does. And that's what we can use to our advantage. This is a chart showing temperatures starting in 2020 and letting the clock run on the black line as if we are not doing very much beyond what is business as usual. Temperatures would rise 1 degree Celsius by about 2050. If we meet the global methane pledge, they will be about 0.2 degrees Celsius lower. Now, just for context, we are at 1.1 degrees Celsius of warming, and we want to stop warming by 1.5 degrees Celsius. So that 0.4 degrees Celsius is a very small window in which, if methane allows us a 0.2 degrees Celsius head start, that's amazing. This is probably the scariest chart I've seen as a climate journalist. It was tucked in the IPCC report that was published in August this year. Now, let's get the bottom two parts out of the way first. Solar and volcanic drivers. This is telling you what are the different variables that contribute to warming on the planet. Climate skeptic talking points have been, well, climate change has always happened and it's just nature that's running its course. Well, we know that's not the case because neither solar radiation nor volcanic emissions have been able to either cool down or warm up the planet, and any other internal variable that we can track and have been tracking for decades does not contribute. Now, the scary part of this is the second bar, which says all the greenhouse gases that we have emitted are actually enough to already heat the planet by 1.5 degrees Celsius. And yet, the observed warming is only 1.1. That's because, ironically, the same fossil fuels that we use to put out greenhouse gases into the atmosphere also produce particulate matter pollution or aerosols, which have a cooling impact because they produce this layer in the upper atmosphere that reflects sunlight. As we get to net zero, we're going to have to cut fossil fuel emissions, which means we will cut air pollution. That's great for health, but we will get some short-term warming in the process. And using methane as a reduction tool at the same time as you're cutting fossil fuel emissions can help us counteract that short-term warming. That makes methane another reason why we should be acting on it. So how do we do it? Well, let's look at the sources. There are four major sources, right? Livestock, which is mostly growing cows, oil and gas and coal, marked in orange, waste, which is coming both from landfill and wastewater treatment, and rice, which is, when it's produced, it produces methane during the production process. Now, what the chart shows is the dark bar is where we have both the technology and the economics behind us to be able to cut methane, which is to say it's actually profitable for almost 50% of all emissions that come from oil and gas to be cut profitably today. And more oil and gas companies aren't able to get away with it. We now have eyes in the skies, satellite monitoring, which can tell us where exactly a leak has come from around the globe. Then we can send people on the ground with specialized cameras to be able to turn an invisible gas visible and then seal those leaks, essentially with sophisticated plumbing. And oil and gas companies are realizing that they are being watched. And so when we as reporters, you will have seen the Bloomberg Green magazine, which has methane as its theme for this issue. When we as reporters go and talk to oil and gas companies, some say, yes, there's a leak, we're going to fix it. Others say, well, those leaks are within legal boundaries. And so we have to, as society, as journalists, hold these companies accountable if we want to cut emissions. And that's crucial because the other part of methane emissions is very hard to cut. So livestock, we don't actually yet have technologies that can be scaled up to be able to reduce emissions. This is a startup based in the UK called Zelp, which is building, as you can see, maybe slightly, masks for cows. And about 90% of emissions that come from cows in form of methane are actually burps. And so you build these masks to be able to trap some of those methane and reduce those emissions. But this is all very early stage, and that's why cutting emissions from the oil and gas sector is even more important. So let's come back to COP26. We got the global methane pledge, which said that we'll be able to cut emissions by about 30% by 2030. And that could really help us give the time that we need to be able to keep 1.5 degrees Celsius alive. But the global methane pledge is actually weaker than it ought to be. Scientists told us that we need to cut emissions for methane 45% by 2030. The target for the global methane pledge is only 30%. It also doesn't have the biggest emitters. India, Russia, China haven't signed up. And it's a global collective pledge, which means some countries have signed up and can get away with doing nothing while others have to do more. And so this is where the change needs to happen, where we've got these pledges and now we need to get into implementation. Cutting methane emissions could be the quickest solution that we can use to try and address climate change. Thank you.
Thank you for joining the first portion of today's program. We're going to take a quick break, so grab a coffee, stretch your legs, and meet us back here at 11 a.m. Eastern Time for the second half of the day.
ESG isn't only about windmills and clear streams. It's a powerful investment analysis tool. It's about seeking to reduce risk and uncovering opportunities, meeting mandates, reaching financial goals. It's time to turn blue sky thinking into solutions-based investing, because after all, ESG means business.
I'm the General Manager for Bloomberg Green, and I'm thrilled to be joined today by Clarice Avery, Senior Vice President, Investment Strategist for Natixis Investment Managers, and Natalie Wallace, who's the Global Head of Sustainable Investment at Natixis Investment Managers. Thank you both so much for joining me for this Natixis Investment Managers Advisory Board Spotlight. Today we're going to be focusing on investing in the transition, really thinking about this as just the tip of the iceberg. And so, Natalie, I want to start with you. Tell us about the key investment drivers that are driving the energy transition.
Yeah, there are many investment drivers, but the first one I would say is that many governments around the world have called climate change the existential threat of our time and to financial markets. We've heard it during and after COP26, really the changing nature of our energy consumption and production is impacting investors around the world. The demand of energy is also being transformed with more and more consumers and users of energy going for electricity and renewable energy. And we see that in obviously transportation. The technological shift that is happening as well in terms of lowering the cost for renewable energy is having a deep impact on how we consume this energy and which tools we use to consume energy.
And Clarice, from your perspective, what are the opportunities and challenges for positioning portfolios today?
Yeah, there are certainly many opportunities and maybe just as many challenges for positioning investment portfolios today. But just to highlight a few opportunities, I'd say the energy transition certainly presents the opportunity for investors to reposition portfolios to better manage risks related to the energy transition, but also to capitalize on new opportunities such as those related to new and disruptive technologies and climate solutions, which will continue to emerge and evolve and will present opportunities across industries, but also up and down the value chain. I'd say it also creates the opportunity for investors to play a positive role in the transition, to align portfolios with broader climate objectives and to help mobilize capital toward the areas that require it most. Many of the challenges with positioning portfolios in this context relate to the sheer complexity of these issues. The first challenge, I think, is understanding where portfolios are today and how they're exposed to these risks related to the energy transition. And then it is how do we effectively manage those risks and implement the changes needed to transition the portfolio. Part of this challenge, on the one hand, is that the availability and reliability of emissions data and corporate reporting are not perfect today. And on the other hand, there is the challenge in determining what is the appropriate strategy going forward. Is it enough to simply divest from high-emitting companies where you're effectively just transferring ownership to someone else? Or do we stay invested with high-emitting companies and engage with them and support them in their transition? Do we divert capital to companies offering climate solutions? So there's a lot to think about for investors going forward. And lastly, I would say another challenge is just in portfolio measurement and reporting and being able to demonstrate these outcomes to end investors, which is certainly an evolving topic.
And Natalie, continuing from what Clarice just brought up, how do we measure and compare the effectiveness of decarbonizing portfolios?
Right, that's the question, given that there's two aspects here I would like to mention. One is obviously it's easy to decarbonize portfolio by divesting from very high emitting sectors. As Clarice mentioned, sometimes with limited impact on the real world, given that others will be buying these assets. So you just transfer away that problem from your portfolio, but really the problem in the real economy and emissions keep on existing. The first issue in decarbonizing portfolio is to measure. How do we measure carbon emission? As Clarice said, the availability, comparability, reliability of this data is an issue. A very minimum amount of companies today report on Scope 1 and Scope 2, even less report on Scope 3, which is that supply chain, emission in the supply chain of a company, downstream and upstream. And this is a challenge. It's important to move away from this standard carbon emission measurement, Scope 1 and 2 of what the company energy related emissions are, and really look at the full picture of the real impact of a company across the full spectrum of the life cycle of a product. The other issue is to understand how a company is positioning for the energy and climate transition, or if it's also really positioning for assessing and monitoring and managing climate-related risks, including physical risks. And that's a difficult part of the equation for any investors. Thus, understanding how effective your portfolios are at decarbonizing the real world, it entails to be really active owners and really engaging with companies on these issues, and the strategic objective of the company to decarbonize, again, their full operations from upstream to downstream of their operations and products.
Clarice, I would love to get your investor opinion on carbon offsets. Do you think carbon offsets are a good tool for investors?
Yeah, and this is certainly related to what Natalie was just talking about. We do believe carbon offsets, if used appropriately, can be a helpful tool, but there certainly are some risks to be aware of. So first of all, what are carbon offsets? Offsets are created by various projects, such as those related to land restoration or reforestation, for example, projects that result in the reduction or removal of emissions to offset or compensate for emissions elsewhere. So why would we look at using carbon offsets? We know, right, the path to net zero and the energy transition requires major transitions in our energy systems and across industries to reduce emissions. But because we cannot eliminate all emissions today, it also requires the removal or offsetting of remaining emissions in the atmosphere. And this is where carbon offsets do play an important role, at least in the short term. So organizations can invest in carbon offset projects or purchase carbon offset credits to offset those emissions that they cannot eliminate by other means at the given time, which of course is easier for some types of organizations and certain industries than others. And over time, this mechanism should encourage public and private actors to reduce emissions where and when they can, and help spur innovation and investment in climate action, with the ultimate goal of reducing the need for carbon offsets altogether over time. But there are some risks to be aware of. First, these are largely unregulated markets and local projects, meaning traceability and greenwashing could be concerns. For example, a project may not be as effective at offsetting emissions as intended, or it could be that the reduction of emissions would have happened anyway. So the questions of standards and additionality come in. And another is that, and maybe most importantly, is that public and private actors may rely too heavily on carbon offsets to reduce their overall emissions profile while avoiding the more challenging acts of setting a broader strategy and significantly reducing actual emissions. And in that way, the tool could serve as a distraction from the actions that are really required going forward. So yes, important tool in the short term, but it's important to understand the use cases and limitations and to really ensure that we're not overly reliant on them.
Natalie, I want to end with you helping us to look ahead. So the International Sustainability Standards Board and the SEC are expected to mandate climate-related disclosures for corporates. How do you think that would impact capital allocation?
Well, it will impact capital allocation as we will have access to more tangible information from corporates, especially related to climate risks. Today, as we mentioned earlier, a lot of these are either not available or estimated, and thus really having a mandatory disclosure requirements on carbon emission, but also forward-looking metrics would be extremely helpful for investors and allow them to allocate capital in a much more efficient way. So we are really much looking forward to a transforming landscape in terms of access to information, access to climate risks disclosure, and being able to assess how a company is exposed to and positioning for the forward-looking strategic investments and capex that they are going to do to reduce their carbon footprint. And this is extremely valuable information for investors.
Thank you so much again, Natalie and Clarice, and thank you to New Texas Investment Managers.
Thank you for having us.
Thank you.
Hi, everyone. I'm Carol Masser. I'm host and anchor of Bloomberg Business Week on Bloomberg Radio, TV, and YouTube. And I've got a great duo to talk about building a sustainable brand. Of course, you probably recognize them. Steve Case, of course, he is the chairman and CEO of Revolution, co-founder of America Online. And also with me is David Lee. He's president and board member of App Harvest. He was also CFO of Impossible Foods and Zynga. So I want to just jump right in, guys. First of all, Steve, I am thinking you invested in App Harvest. I'm thinking lots of things come across your inbox or across your virtual desk, if you will. Why did you invest in App Harvest? What stood out for you?
A bunch of things. So starting with the founder, Jonathan Webb, who basically came to our office here in Washington, D.C. about 4 years ago with a bunch of binders and what seemed like a crazy idea of building a significant ag tech company in Eastern Kentucky, kind of coal country, which had been decimated over the last several decades. But he had some experience working in the U.S. government, including what was happening in solar around the world, and also saw what was happening with agriculture in places like Europe, and said this can be done in the United States. This could be done in Eastern Kentucky. We can create hundreds of jobs there and also do it in a much more sustainable way, because that location in Eastern Kentucky is within, 70% of the U.S. population is within a 24-hour drive, and it uses 90% less water. So it was just an idea, really kind of on a napkin with some things from Europe showing what was possible in other places. But we were captivated by the idea, and that's now scaled to a pretty significant company. It was great when David joined as a board member and then as president to help really scale this company and really create opportunity in a place that has been left behind, and really help reimagine our agricultural system, which is one of the areas that's most needed in terms of dealing with climate change, in terms of a sustainable approach to ag.
And David, come on in. So what's it like working with Revolution and Steve and the team over there?
Oh, it's been a joy, having partners who understand both technology as well as how the consumer is now demanding better food, food that doesn't hurt climate as much, food that sustains and nourishes them, food that's not imported from far outside their community. And so being able to find that expertise with a company in Appalachia, based in Kentucky, has meant that I have greater optimism and hope that entrepreneurs, across the world will have access to capital to do better by the world, but also to do right by investors at the same time. It's been very exciting.
Well, I do also wonder about sustainable or sustainability, how we define it. I feel like we're all learning in real time, just like we learned about a lot of things about the creation of a vaccine in real time because of the pandemic. So, David, there's sustainable agriculture and then there's sustainable agriculture. What have you learned from going from impossible, and we've all been over, protein-based food, like thinking that this is a great way to move forward. What have you learned from going from impossible to App Harvest about what really maybe sustainable ag is all about?
Well, it's interesting, 20 years ago, neither the consumer nor the investor were as well developed or sophisticated in finding companies and technology that I call have positive externalities, that stand on their own feet for investors, but happen to do well by the world. And if you think about food, it was relatively not well understood how important what we eat contributes to the climate we can preserve. at Impossible, it was great to find a way to give meat eaters something that hit the spot from a taste standpoint, but arguably is much better for climate and for health. But the need is much bigger. What I've learned in working with Steve and Jonathan Webb at AppHarvest is, listen, by 2050, we just can't make enough plants to feed the need globally, forgetting for the moment about the incredible need for better meat. And, if we use 60 to 70% of all fresh water today in the way in which we make food, but we need 70% more food by 2050, we have to rely upon technology and smart capital, or our kids will see food lines due to food insecurity. And so the need is urgent. And I think that need is more and more understood, not just by great investors. It's a great thing that we could access the public markets, because it does take a fair amount of capex to build these technology sophisticated farms that have 30% times better yield. So the need is there, and consumers are now waking up that they can be part of the solution by really voting with their stomach and making a positive difference on climate.
So, Steve, how do you think about sustainable investments and sustainability, and maybe how has your thinking about it maybe progressed as you continue to do it? You have a bunch of companies in your portfolio, but how should we be thinking about it, and how do you think about it?
I think the broad trend in the last decade in terms of the growth and interest in sustainability in the last several years, a real acceleration of investment in ESG, I think bodes really well. I think the perception 10 or 15 years ago was this is sort of a good thing to do, but wasn't necessarily a profitable thing to do. That's clearly changed. Some of the most valuable companies now being created are focused on sustainability. AppHarvest obviously being one. We also backed Sweet Green. Recently went public with a very, very strong focus on sustainability and even a board committee focused on ESG. We also backed Temper Pack, which is trying to focus on sustainable packaging, rid the world of styrofoam, which is terrible for the environment, by using a better packaging. And a lot of big food companies like HelloFresh and Daily Harvest use it, as well as pharma companies. So it's identifying problems out there that need new solutions that are good business opportunities, while also being much more sustainable in terms of what they're doing and the impact it will have on the planet. I think there's a rush to focus on these from the entrepreneurial sector, a rush to invest in these from obviously the investor sector, but also a rush from a customer standpoint, consumer standpoint. They really want to do business with companies that care about the world and care about the planet and have a strategy and a real commitment to sustainability.
Are we being smart enough as an investment base, Steve, to give companies time? AppHarvest, you went public this year. It's been, I would say, a volatile IPO market. But I do wonder, Steve, are we thinking about that balance between we need to be more sustainable as a world, right? Otherwise, there ain't going to be anything left. So are we understanding enough? Are we sophisticated enough as investors to understand that there's got to be a balance to let these companies grow, to make their investments, and maybe at the risk of short-term financial performance, but longer-term, this makes sense because it's got to be where the world goes.
Yeah, every company is a little bit different, but you have to figure out what your time horizon is and make sure you're educating investors, whether you're a private company or a public company, on that. Sweet Green, which started 14 years ago, has done that and has built up a significant business that's scaling quite nicely. AppHarvest started just 4 years ago, as I mentioned, and was able to go public and access the capital markets to dramatically expand what they're doing on the production side with new facilities, not just the initial one in Eastern Kentucky, but many others, and also invest heavily in technology, particularly robotic technology. So they were able to use that capital, and they educated the market at the time they went public that this really is something that will build significantly over the next decade. But we need access to the capital markets to be able to execute an ambitious plan to really build AppHarvest as a company and build it as a brand. And that's the path they're on right now.
David, what is it like the conversations you're having with investors like Steve, with others, now that you're public, a public company, in terms of what they want to see, what kind of transparency they want to see, though, to understand, hey, this is a true sustainable investment?
Well, one of the hallmarks, I think, in being public when you're interested in large global impact is every day you are educating the public investor. Every quarter, you have radical transparency, not just to what your financial results are, but frankly, the commitment we have to sustainability. We have a high bar because we have gone to investors that are the most sophisticated in the world. With that access and capital comes the chance for us to radically speed up how many of these large technology enabled greenhouses we can produce. For perspective, our first farm in Eastern Kentucky is 2.8 million square feet, right? It has a water reservoir that allows us to use 90% less water, but that water reservoir is something like 50 Olympic swimming pools large. So the scale of the impact that, frankly, we need as a community means that we have to bear the radical bright light of being public. It has a great benefit, but companies have to be prepared every day, every quarter to be scrutinized. And that is different than when a lot of these companies only could access the private capital markets. It is a great opportunity, but it has a real burden and cost to the team to make sure that they can operate to the rigor of the public markets.
Hey, David, what's more difficult, being a public company or dealing with kind of the infrastructure, the establishment of how we do agriculture right now, dealing with kind of the old way and coming up against that? That's
a great question. I'll give you an example. Back in the early 2000s, I was running a public company called Del Monte Foods. And, back then we knew at the company level that climate change was a problem. People were pulling out peach trees in California and planting nut trees because the climate couldn't serve it. That was 20 plus years ago. And what I would say today, the answer to your question is that there's so much more awareness by the consumer who is really demanding better food. You see it in all the great brands and companies, Sweetgreen that was mentioned already by Steve, but look at all the companies that have gone public in the last 10 years that are really dedicated to a better future for food. It's no longer the case that because consumers are demanding this, that staying in the shelter of being private is the easier answer. I actually think that the infrastructure that is being put in place is now part of the broader incumbent food industry. It's no longer us versus them. We are in partnership with the largest retailers. We are in partnership with the largest supply chain providers for our greenhouses. And it's because we're trying to be part of the mainstream food industry. It's a big change from back in the day when I would largely ignore at Del Monte Foods some of these smaller, sustainably minded entrepreneurs. It can't be ignored anymore because consumers and investors are really demanding it.
And the other thing I'd add to that is we've seen in the last decade a greater focus on sustainability and better access to the capital markets, whether they be at the private company level or the public company level. And that's actually made companies like AppHarvest possible. Early on, 10, 15 years ago, some of the initial investments in sustainability, climate tech, some other areas, a lot of those companies failed because they were big ideas that required significant capital and required a longer runway, a 10-plus year runway. And it was difficult for venture capitalists to back those companies. A lot of great ideas. Some were successful, like a Tesla, but many others struggled and many failed. So being able to access the capital markets so you can get the kind of capital you need to really run a kind of a moonshot play to build a significant, durable, kind of company is more possible today. And that's why you're seeing more breakout successes like AppHarvest and Sweetgreen and so many others.
Steve, what's the due diligence that you do, like on a company, to really say, all right, this to me has a strong, sustainable, they're building a sustainable brand. They're in it, they're transparent. How deep do you have to go?
We go fairly deep. I should say at Revolution, we have three groups: Revolution Growth, which is sort of the later stage growth investing, Revolution Ventures, kind of early Series A investing, and the Rise the Rest Seed Fund, which is what backed AppHarvest 4 years ago, which is obviously a very early stage seed investing. How we diligence companies at those stages obviously matters. At the seed stage, it's more of an idea. The venture stage, it's more of a company. At the growth stage, it's really the question is how big can it be and how does it compete in a more competitive market, and how can you really accelerate the growth by investing not just capital but also time and reputation and so forth. And then for companies that do fall into the sustainability ESG bucket, which we're seeing more and more companies like that, then you really do need to understand what their commitment is, what their vision is. Are they identifying in very specific ways what metrics they're going to be held accountable to and be transparent about those? Are they able to work with their suppliers and connect with their consumers in a authentic kind of way. So it does require an additional level of diligence to really make sure the companies you're backing aren't just talking a good game, but actually committed to executing that game.
I think about things too that kind of move our mind meld and our mind thinking process or thought process. Coming out of COP and COP20, coming out of COP26, Steve, what are your thoughts from an investor perspective that maybe there was something said or something done or a timeline laid out that you said, all right, this is something I want to be looking into as an investor, or maybe you already were, but maybe you're going to move in even deeper.
No, we obviously have been for a number of years, but like a lot of investment firms, we're looking at more and more opportunities in this space, and even the fact that Bloomberg is hosting this summit, I think, is a sign that this is emerging as a really interesting space, and there's a lot more investor interest in it. I think the key message from those meetings was climate, while always a problem and continuing to be a problem, is also an opportunity. And people who just viewed it 10 years ago or 20 years ago as a problem now see it. There's also an opportunity to back some of these companies and really have system-wide kind of a change in industries. As David said at the beginning, what's interesting about agriculture and a company like AppHarvest, it's focused on taking a very important sector of our lives and a very large sector of our economy and innovating to make it more sustainable. At the same time, because of the connection with food, it's long been said, you are what you eat. That has a direct impact on healthcare, which is another obviously huge industry and a lot of challenges associated with healthcare, while also having a positive impact on climate and being part of the sustainability revolution. So it really was kind of the trifecta. The core focus was on better, healthier food and creating jobs in a place like Eastern Kentucky, while also having a direct impact on improving health outcomes, lowering healthcare costs for this country and other countries, and being a positive kind of part of the solution around sustainability. So that's why a company like AppHarvest really kind of became something so exciting to back.
Yeah, it's pretty significant that it ticks so many key boxes, if you will, more than ticking the boxes, actually moving the needle on it. What about your thoughts, David, coming out of COP from an ag tech perspective? Anything that kind of came, that a light bulb went off or something, and you're like, wait.
Absolutely. We've come a long way. This latest climate summit and treaty reflect that. I remember the first one. I think it was based in Paris years ago, and just explaining to the most sustainably minded entrepreneurs, investors, folks in the public sector that animal agriculture contributed, almost as much, or some would argue more, to the emissions for climate change than all forms of transportation combined. And yet at that first summit, I heard the story that everyone tucked into a lovely steak dinner at the end of it. When you now look at the conversations happening globally, what you're seeing is that people are not just thinking about sustainability as the avoidance of harm. Let's not invest in X, Y, and Z. They're looking at creating new forms of industry that can financially sustain themselves, that have a big impact on climate. One of the things at AppHarvest that we're working very hard to do is to give this part of the country that's been overlooked, that kind of went through the difficulty of a coal mining demise, access to living wage and jobs, to give careers. We have these container farms in Eastern Kentucky. To see the light in the eyes of high schoolers who see a career path for Appalachia to be the headquarters of sustainable ag, we hope one day, is a big part of our story of ESG. It's not just about climate. It's not just about health. It's about empowering communities to be able to sustain real effort to do well and to do good.
Well, and I think about this, Steve, pre-pandemic, right? Your bus tours and going out into communities. And I think David brings up a really good point. We think about climate a lot, and very important, no doubt about it. But I mean, we also need to, especially at a time when we're talking so much about the gap between those who have and those who do not. I mean, it just gets worse and worse. We need to be thinking about the impact companies are also having on workers.
Absolutely. There's a lot of focus, as there should be, on income inequality, as you mentioned, but there's also needs to be more of a focus on opportunity inequality. There are a lot of parts of the country that have been struggling, that the disruption that we celebrate in places like Silicon Valley basically is resulting in a loss of jobs in that family, in that community, and a resentment growing around what's happening. So we have to offset that by backing companies there, new companies there, startups there that can create jobs there. And AppHarvest is a perfect example. That's why we launched the Rise of Rest bus tours and more recently the Rise the Rest seed fund. We've now invested in 180 companies in 80 different cities, and we're seeing remarkable momentum in the growth and value creation of those companies and the impact they can have on society, but also the impact they can have on those communities by creating good jobs there and giving people in that community a reason to be hopeful. And if you're already there, to stay, not leave. And if you left, to boomerang back. And the pandemic has accelerated some of those trends. We're seeing more of a dispersion of talent, also more of a dispersion of capital. We actually just released a report this morning in conjunction with PitchBook. You can get on our revolution.com site that was titled Beyond Silicon Valley. And there's some remarkable trends in terms of what's happened just in the last 10 years in terms of more capital flowing to these cities, more venture firms starting in these cities. And we're seeing much more breakout successes like App Harvest. Yeah, and I think the story, over the next decade will not just be about Silicon Valley. It will be about all these different rising cities, dozens of them, not just a few, that are going to create some of the breakout companies of tomorrow, including the ones that understand the importance of sustainability and the process, level the playing field in terms of jobs and opportunity and hope all across the country.
Just quickly, a minute left, 30 seconds each. David, what advice would you give to a sustainability startup?
My advice would be is to really focus on the consumer. Consumerism can be a powerful force of adoption. It's not just good enough to create a good technology and have great investors. Thankfully, we had Steve. You have to create a go-to-market strategy where consumers demand a change, that they create their future by their choice. We're trying to do that at App Harvest, steady, step by step, but we have a long ways to go.
Steve, your advice.
Pick a battle worth fighting, a mountain worth climbing, something that is important to society, that is important to the world, and then build a team. And entrepreneurship is really a team sport to tackle that and understand that the innovations in ag tech, in healthcare, in so many other sectors are going to require more of an understanding of policy because these are regulated sectors and you should understand that, lean into that, and respect that. And also will require partnerships. These are not businesses like apps of the internet second wave where you drop it in the app store and you hope it takes off virally. These require systems level change, system level thinking, and partnerships and policy are critical, which is why that's always been the focus at Revolution.
Disruption, innovation. Steve, David, thank you so much. Really appreciate it. It's so great to talk with both of you again. Stay well. Talk to you soon.
Thanks.
Thanks.
Hello, everyone. I'm Jessica Shankelman, and I'm a journalist with Bloomberg News. I'm excited to be joined today by a great panel of experts to talk about finance in a post-COP26 world. Many of us are still recovering from the intense 2 weeks in Glasgow at the beginning of November. So please join me in welcoming them to the virtual stage. There's Catherine de Konik-Lopez, who's the global head of ESG at Invesco, Neely Gilbert, vice chairwoman at Carbon Direct, and Jana Watson-Kukar, global managing partner emeritus at Dalberg Advisors. And as always, with all these panels, we'd love to have your questions as well as the questions that I'm asking. So please do, if you have questions for our panelists, type them in the white tab to the right of the video window and then hit submit. And then we're going to be saving a few minutes towards the end of the session to get to those as well. So Neely, I want to start by asking you about GFANZ. Perhaps not the sexiest acronym out there, but it was a part of a major announcement at COP26. A group of all sorts of financial firms led by Mark Carney, the former Bank of England governor, said that that number of companies representing 100 trillion now are committed to reaching net zero. So that doesn't mean they actually are net zero, but they're on the path to getting there. So that was the big announcement we had at COP. What are you expecting as a member of GFANZ to happen over the next year ahead of the Sharm el-Sheikh conference, COP27 conference next year?
Well, first of all, thank you for having me. And you're right. I guess that our responsible investment community is not that great with acronyms, but we are getting good at serious initiatives. contributing towards all of our shared goals. So by way of background, the Glasgow Financial Alliance for Net Zero, as you said, now represents about 450 financial institutions worldwide and around $130 trillion in capital. I come to GFANZ in my role as the chair of the investment committee for the David Rockefeller Fund, which is a member of the Net Zero Asset Owners Alliance. And then GFANZ is essentially an alliance of alliances from asset owners to asset managers, banks, insurance companies, and service providers. So all of these companies have committed to transition the assets that they control to net zero by 2050, but importantly, also committed to making interim targets over the next 5 to 10 years to decarbonize their fair share of global emissions in that time. So in terms of what you can expect from our group in 2022, first of all, some members are just now joined in advance of COP26. And so they'll have 12 to 18 months to move from those pledges to announce their official interim targets, as I was describing. And then those who have already joined and made their targets will be moving forward with action towards those targets, demonstrating visible leadership on the ground in terms of what we mean when we talk about net zero. So I'm very excited when you think about COP26. I've heard some people say that this was the commitment COP. And I think when we move forward towards COP27, that what the industry and the world should expect to see is moving from commitments to action and accountability.
And Carbon Direct, one of the things that you do is invest in carbon removal technologies. That's things like direct air capture, carbon capture and storage. And we saw at COP26, there was a big focus on offsets. Countries finally managed to agree the framework for rules around carbon markets. And there's been lots of questions around the kinds of offsets that people are buying. And more, we hear about the importance of investing in carbon removal, not just offsets that avoid emissions, things like wind turbines, but removals. Do you see what happened at COP26 around Article 6 really sort of driving investment in carbon removal technologies? Do you think 2022 is going to be the year that we see a step change in investment in carbon removals?
Yes, we should all hope so. Of course, institutions around the world will do everything that they can to reduce emissions. And the truth is that we also will need to remove significant amounts of carbon that are already in the atmosphere and deal with the emissions that will be hard to abate. And so the progress that we made at COP26 on getting clarity around standards for Article 6 is a start, but we continue to need more clear and high quality standards for what we mean when we talk about removals. And so when I joined Carbon Direct recently as vice chairwoman, it was really because of the focus that the company places on science-based standards for what we mean when we talk about quality when it comes to the removal space. What we should expect to see is greater convergence between the standards that are being put forward by the private sector in terms of voluntary carbon markets and the progress that's being made with Article 6 and with individual, national and local governments in terms of their own standards.
And just a reminder again to the audience, please do put your questions in the white tab to the right of the window and hit submit. We really want to hear what you're thinking about what our panelists are saying. Catherine, I want to turn to you. Now, at the end of COP26, of course, we had that big announcement. The Glasgow Climate Pact was signed by 197 countries. But along those 2 weeks, we had what seemed like endless announcements along different lines about agriculture, on deforestation, on transport, on reducing coal. And some of those announcements included companies, and they also included some countries, but none of them included all 197 countries that were present at COP. Do you think that those side deals that came with all that fanfare, do you think that they are as effective as the final agreement that was made at COP26 when they're just voluntary?
Well, so from my perspective, I think in some ways they are even more powerful because this is the wider society, this is the wider ecosystem that is really mobilizing around climate change. And I would say specifically net zero. And just picking up on Neely's point there, specifically on GFANS, we are at Invesco part of the Net Zero Asset Manager initiative and are in the process, in that 12 to 18 month process where we're going through, setting our ambitions and targets, et cetera. So I think, just our organization, but also the wider financial services organizations, as you mentioned, over $100 trillion of assets, 450 institutions, that is meaningful. And I think COP26 was a significant accelerator and driver of some of those commitments coming out. So even just that in itself is incredibly powerful. I would say some of the other things that we're, taking notice of and that I personally think is very important, the deforestation pledge and the electric vehicle pledges. Those two, I think, are really, really important, particularly deforestation around, natural, nature-based solutions, looking at conservation finance. All of those topics, I think, are areas that have a lot more room to grow. And I think as, the finance world really contributing to that deforestation pledge will be incredibly important. And on the electric vehicle side, I think, again, that's the auto sector obviously is a big sector of investments, and having those pledges, that is meaningful change for that industry overall. And it's also going to drive supply chain changes. The whole ecosystem is becoming more, lower carbon over time, which I think is really, really powerful.
So do you expect, for example, that deforestation pledge to have a material impact on the financial flows that we're seeing around the world, and whether they're going into tearing down rainforests or planting new trees, for example?
Yeah, and I think actually to some extent, as Neely mentioned it, you can already see that the corporates making big pledges around net zero. You're having that, the whole offsets market, effectively carbon market around that is becoming a corporate reality, right? Because it has to be, as you can get so far with your own actions, but at some point you are going to have to, invest back in and I would say in kind of natural sinks, right? And that is forestation and conservation. And so I see them as very closely linked.
And I mean, Jana, I don't know, when COP was happening, personally, I found it quite difficult to always understand the business angle of these decisions that governments are making. They're arguing over the minutiae of different legal texts. So how do you join the dots from those agreements that governments are making to then deciding, well, what does this mean for an investor?
Thanks, Jess. And I'm glad you actually used that expression, joining the dots, because I think that's exactly the imperative now. The time has come now not to debate any longer whether COP26 was everything we needed it to be, but rather, how do we now connect the dots between the commitments made and the capital? What I think is salient is that COPs produce policies, and those policy commitments move markets. Now it's incumbent on us to say, when the market opens, is the capital getting to the companies that can then scale and grow in those markets? When I look at even a relatively small country like Costa Rica, Costa Rica, I loved how the president described himself, in Costa Rica as a hummingbird in Central America, recognizing that they are not the largest country, but nonetheless, they're very much on the pathway for the Paris Agreement. Now, the electrification commitment that the president has made, that Costa Rica has made, and the policy commitments that Costa Rica has made as part of this broader COP fabric has created an enormous market for electric vehicles in Costa Rica. Interestingly, though, as of just a couple of years ago, there were twice as many new cars, not electric, being registered in Costa Rica as there were babies being born. So you have, policies coming out that are creating market opportunities. And yet I look at a country like Costa Rica and I see a wide open market just waiting for the capital, for the electric vehicle infrastructure to be able to scale and grow. That's what I hope that we see next. That's the action we need.
When we were at COP, the issue that came up over and over again, and of course not for the first time at this COP, was about how developing countries can access finance. I remember hearing Kenya's environment minister speaking very passionately to Frans Timmermans of the EU, saying, it's all very well you saying that there's this billions of dollars a year coming forward, but we aren't able to access it, and it takes years for us to be able to even get it when we do apply. So how can the private sector help developing countries to access the finance that they need to either adapt to climate change or to invest in the green technologies to decarbonize their grids?
Yes, I'll say that this is where I see a gap between rhetoric and reality, and we need to be in the business of closing that gap. The financial community can do a lot to help developing countries access the finance they need. If I look at South Africa, for example, I was delighted to see, the Just Energy Transition Partnership announced, but $8 billion for South Africa to decarbonize its economy, while it sounds like a lot, is a drop in the proverbial bucket. The estimates are it's 25 to 30 billion would be needed for that transition. So from the perspective of the financial sector, on the one hand, South Africa has a very coal-driven economy. On the other hand, there's this commitment now to move towards electrification. How the financial sector can get involved is to sort of say, look at the country and say, A, where do we have legacy investments in coal and other non-green investments of that ilk? And, are we going to commit to not making any further investments of that kind? Now, pragmatically speaking, that's not always feasible. But if the financial sector can be frank about, look, we still have quite a bit of oil and gas and similar kinds of investments and financing going that direction. So we're going to be all the more forward-leaning in whether it is developing green bonds for a country like South Africa. There's a whole range of financial instruments that the sector, could explore, but making sure that we bridge, don't just say as a financial sector that we're going to lean into green investing and green financing, but to be frank about what we're already doing that is not so green, what we're going to do going forward that is far greener, and get creative about it so that the countries like South Africa can make a transition, can get the capital they need, but make the transition in a way that is mindful of the broader sort of economic context, not losing jobs, for example.
And Neelie, I want to ask a similar question to you, because at COP26, we actually got to a point where India was saying we will only step up our carbon commitments if we get $1 trillion by 2030 from rich countries, and all of that has to be public money. We don't want any private money. How did we get to a situation where there was so much anger from a country like India, and how can the private sector show that it can be a force for good in helping a country like India to decarbonize without harming its economy?
Well, I think that a lot of trust has been lost, right, over the course of time from these commitments that have been made and not met. And a lot of that trust has been lost, frankly, from the commitments that were made by the public sector from governments. And so in order to move forward, some of that needs to be redressed. But to the point that was just made, when you look at the scale of capital that's needed, right, it's estimated by 2050 that we'll need $150 trillion to achieve decarbonization worldwide, with 2/3 of that capital going to emerging market and developing countries. It's clear that it will require both government finance, public finance, and private market capital to achieve commitments and funding at this scale. And so what I think that we really need to do is to leverage structures like blended capital that bring together that public funding with private capital, and in some cases also philanthropic capital, in combined structures, innovative structures, to be able to meet these needs. And when I say innovation, it's not that we don't know how to do this. The blended finance has been around for a long time. In some ways, I think it's innovation and improvements in the structure of the system, what we kind of call the plumbing of the system, to be able to make this work well. So on the one hand, certainly rebuilding trust, but on the other hand, being realistic about what will be required to actually get this done.
If I can actually just piggyback on that. Pardon me, I want to build on what Neely said, and I think maybe just punctuate it with, a bit of a dose of reality. As Neely says, this trust has been lost, but also if you're a developing nation and you have South Africa, India, China, and you have an economy that is already sort of in the throes of struggling with a poverty agenda, and you're being told by developed countries that have used coal and all manner of non-renewable resources to scale their economy in their countries over the past century plus, it's sort of, the righteous anger can be understood, I think, from all sides. And so when India did end up watering down that commitment to phase down coal versus phase out, I can understand the frustration because, India being a bit bolder with that would have made a difference. But I can also understand it from India's perspective, which is even phasing down is an enormous relative commitment on behalf of that country versus what other developed countries are committing to.
Thank you. And Catherine, going forward to COP27, we've got a question from our audience member who says, what commitments or action do you hope to see at COP27 that we didn't see at COP26? And whether that's on finance or any other areas, feel free to talk about them.
Well, I think the big one is the NDCs, right? So next year we will see the reevaluations of 1 year NDC reevaluation, which was agreed in COP26, and we'll see that next year. And I think that'll be really, really important to kind of hold companies accountable, see the real impact of Article 6, and really see how companies are or countries are scaling and, being more bold with their commitments. I think that'll be what I'm really looking forward to at COP27. From the wider partnerships and wider private markets and wider stakeholder commitments, I think we will continue to see more sector-specific pledges, issues coming to the fore in a similar way that we did at COP26. And I think that's really exciting that we increasingly seeing that whole ecosystem making pledges. There were sectors that were being discussed, such as the shipping industry, the supply chain issues we're facing now. How can we make supply chains more sustainable? Just at a very macro scale, I think those are some of the issues that will come to the fore at COP27.
And if anyone else wants to take that question as well, please jump in. No? Okay.
I was not wanting to hog, but I will say I think COP27 will be all about what Neely said at the very beginning, which is about accountability. I think commitments are fantastic. Hopefully now we start to see detailed action plans. And if COP27 can be about measuring what matters in those action plans, I'll be pleased.
And do you think, we were talking earlier about the loss of trust the loss of sense of trust that was felt by some developing countries, and the way that you understood, and many people I think understood, the anger and how India watered down those final targets. Do you think that kind of theme will continue into the next year as Egypt goes on to host the next COP? Or do you think maybe next year we might see another issue arising?
I would expect we see that to continue. Coal is responsible for about 40% of all the electrification in our world, and that has doubled in the last 20 years since the millennium. And that's because of emerging economies. So I expect this continued slip between cup and mouth, if you will, in the discussion around coal reduction between developing countries and developed countries to continue.
And I've just got 30 seconds to ask a last quick question to Neely. I know we talked about this before, but the Paris Agreement has in its headline goals that all financial flows are supposed to be aligned with low carbon. Do you think that we are now on track, after, for example, the GFAN's announcement at COP, do you think we're now on track for that, or are we still quite some way off?
So the GFAN's members are committed to no or low overshoot scenarios in terms of their net zero goals. And this covers about 40% of private sector capital at this point. So we're on track, but we still have a ways to go.
Okay, thank you for that short answer. I think that's all we've got time for, Catherine, Neely, and Jana. Thanks for such a great, such an interesting conversation. And thank you to the audience for being here today. And thank you to everyone for sharing your insights at the Bloomberg Sustainable Business Summit, Focus on Finance.
Thank you.
Hello, everyone. My name is Dan Barclay. I'm CEO of BMO Capital Markets, a proud sponsor of the Bloomberg Sustainable Business Summit. I'm joined today by Vern Yu, Executive Vice President and CFO of Enbridge Inc., a multinational pipeline company based in Calgary, Alberta. We're here to talk about the principles that guides Enbridge approach to sustainability and how the company puts those principles into action. Vern, it's great to have you here today. Maybe we could kick off and talk about Enbridge's approach and philosophy around sustainability.
Well, thanks for having me, Dan. It's great to be here to talk about sustainability. We've been actively looking at this for many years. Obviously, our job is to provide energy, whether it's conventional or low carbon energy, to the consumers here in North America and Europe. Our job, we believe, it's critically important that people have energy that they can afford, that they need to live their day-to-day lives. So as we've seen preferences shift, and as we've seen we want to reach broader climate change goals, we've shifted our focus on how we deliver what kinds of energy to people. So effectively, we know our job is to deliver conventional energy to people as well as new low carbon energy. We've done a number of things over time to reduce our emissions, and we've crystallized that a little bit with our climate change goals that we've announced earlier this year.
So Vern, tell us about your net zero goal, how you approached it, and the timing is why you chose now.
Well, we've been working on net zero or being sustainable for quite a long period of time. Historically, we've talked about having renewable power for all of our pump stations. We've talked about replacing every tree we cut down in construction with a new tree, and then just reducing our overall footprint. What we've done with our goals is really just formalize them so we have a benchmark that we can measure ourselves against internally and externally with our stakeholders. So it's something we've been doing for many years, but now it's just something that the rest of the world can mark us to as we go forward.
And how committed is the company to net zero? Are you thinking about it in terms of in senior management compensation? We're thinking about it in scorecards. How are you affecting the net zero commitments?
Yeah, so we will be publishing an annual sustainability report. We'll track our progress to our 2030 goal of reducing our footprint very significantly, as well as getting to net zero by 2050. We as senior management are also benchmarked in that for our compensation each and every year. So it's critically important that we drive that change in our operations to really reduce our emissions footprint, as well as improve our diversity and inclusion within our employee base, and work on our governance goals as far as the diversity of the people on our board.
That's excellent. In one of our prior catch-ups, Vern, you talked about this stewardship you had and the long-term approach that Enbridge has been continuing on. And we were talking about the natural gas business and, over the last while, the changes you've been putting in place to make it more sustainable in the distribution in Ontario. Maybe you could bring that to life for us.
Yeah. Obviously, the natural gas business we have is quite large. We're the provider of natural gas for the province of Ontario. So we've been working for at least 2 decades now on just reducing the amount of natural gas people use to run their lives, whether that's to heat their homes, wash their clothes, or heat the water for your shower. So there's lots of little things that each and every one of us can do to reduce that footprint. So we started by modernizing the equipment that we use to deliver the natural gas to people's homes. We've encouraged customers to have a more energy efficient operation within their house, whether that's replacing their furnace or their water heater, installing more insulation, all kinds of different things, perhaps even lowering your thermostat a little bit. By incenting customers to do that and helping them do that, over the last decade and a half, we've effectively eliminated the emissions for about 2 years of natural gas use within the province of Ontario.
Oh, that's outstanding. As you know, I'm a happy Enbridge customer here in Ontario in 2 places. And it's great to see those kind of advances that you've had. And, I see it in my monthly mailer. Enbridge was one of the first companies to create a sustainably linked bond. Vern, what was the rationale on the approach to the targets, and how do you plan to bring those forward?
Well, we believe achieving all of the ESG targets we have, whether it's on the environment, with our employees, or governance, is critically important just to be a good operator in the business. And it gives us what we believe advantages over our peers as we achieve these things. So we felt that this was an opportunity to show our stakeholders in the capital markets that we're committed to doing these things. And if we accomplish these things, obviously we get a small financial benefit in that. So we think it's very well aligned with what we've talked about and published. So we're committed to doing it. And I think these financings really allow us to effectively to put our money where our mouth is.
I think that's right. You got phenomenal reception in that note, and investors are definitely looking for, these published commitments, whether it's your sustainability report, whether it's in a linked loan or a linked bond. The market is definitely focused today on making sure they do their part to assist in the transition. One of the things that I picked up when I was in Glasgow, I was at COP26 last week or 2 weeks ago. was really some of the conversation around opportunity as opposed to just managing risks. And how do you think about sustainability and about energy transition as helping you with business opportunities at Enbridge?
Well, that's a great question, Dan. I think we provide energy for our customers, whether it's the end user driving a car, person heating their home, or businesses and consumers using electricity. So today, we believe about 80% of the energy comes from traditional hydrocarbon sources. We know over time that's going to change in order to meet our climate change goals. So with that transition, there's lots of energy infrastructure that needs to be built. There are many industrial processes that need to be shifted, so that we think there's good opportunity to invest in renewable natural gas, to invest in hydrogen, and to invest in potentially carbon capture and sequestration. We have experience doing all those things. I think we're leading edge, particularly on renewable natural gas, where we've been injecting that into our gas distribution system. And we've started the first commercial scale hydrogen blending into the natural gas stream, again in Ontario, in the Markham region. So as we move forward in time, the globe's going to need more energy. And we're going to be aiming to providing that energy through more energy infrastructure in a more sustainable way.
Well, Vern, I think those are great comments. I have, and BMO is very much focused on the exact same thesis, which is the move to energy transition, both exciting and creates opportunity for our clients to do different things and do them in the right way. It's great to be associated with Enbridge and the progress that you've made. Thanks for spending the time with us today, and look forward to keeping up the dialogue on how we do energy transition and meet our sustainable goals that we both have. Thank you.
Hi, everyone. I'm Shonali Bassick, Global Wall Street correspondent for Bloomberg Television. I'm thrilled today to be joined by Marcy Frost. She is the CEO of Calpers, which is the largest public pension fund in the United States. It serves more than 2 million members, and it has a market value of $495 billion, so really has a lot of weight in the world of investing and in the world of sustainability. Marcy, thank you so much for your time. Marcy, when it comes to sustainability, what do you find is still your biggest challenge with meeting more aggressive goals?
Thank you for the question, and thank you for having me on the program this morning. So for Calpers, that $490 billion portfolio, when we think about transitioning the portfolio into that net zero goal by 2050, there are two things I think that are still problematic for an investor. One is there is a certain amount of data that's not being publicly released by public companies and private companies, and the regulatory environment really needs to help investors to correct that, make that data available and more transparent so that we can use it to make better risk-aware investment decisions. And then I think the second one is really around finding those opportunities. At Calpers, we discount our future liabilities at a 6.8 growth assumption. So finding those opportunities that will allow us to accomplish that 6.8 return on the contributions and the investment earnings that are sitting in that portfolio. I think those are the top two challenges for us as an investor.
Now, let's go to the data aspect of this, because you, alongside Carlyle, one of the biggest private equity firms in the world, had made a very interesting move, drawing in many other pensions as well as private investors to start to disclose data, very specific data, among portfolio companies that your investors hold. How do you expect this data effort to start paying off for you? And what does it ultimately lead to for you in the end?
Yes, so thank you for that. Yes, Carlyle and Calpers co-launched a program around our data convergence project for private markets or private equity. And as I indicated earlier, getting information and data from the public side, working with the regulators to make that mandatory reporting, we also knew that we had very significant holdings in the private assets in the portfolio. And so working with some of our general partners like Carlyle, there are several other GPs, a number of LPs, and that convergence around these topics. And if you think about a general partner and the portfolio companies that they hold across the various vintages, they actually have, I believe, they're better positioned to provide those metrics more consistently. So reporting out greenhouse gas emissions, reporting out net job growth, reporting out employee engagement information. Now, initially, that will be whether those companies are doing an engagement survey. But what I'm hopeful about is after we get these metrics in place, get them consistently applied across all of the portfolios, that we'll be able to get those scores being reported as well. Workers' comp injuries. And so that set of data, we believe, is something that can be commonly applied across the portfolio. There was some, people want to have a lot more data reported, but we think that these are the few to get started with. And so, right now we're in that implementation phase, getting, the general partners to be able to start collecting that data. I believe they do have that data readily available. That's my personal view, and start reporting that out to their limited partners like CalPERS. At the 1 year mark, once we start seeing this data flow in, at the 1 year mark, we'll evaluate the effectiveness of that data and whether we should monitor that differently, whether we should have new metrics, whether those metrics should be changed. And then that really invites the conversation with those general partners and the management of the portfolio companies and how to manage those companies differently to get to that transition point that we all need.
Yeah, I'm interested in this as well because, and I want to be clear, to my understanding, not even the public markets has a standardized way of getting all of this data to investors. And so to see it in the private markets where you're increasing your allocations is a big step. When you look at other pension funds as well as yours, do you think that the companies, the investors that don't start to show progress on these goals will limit themselves in terms of what capital is available to them?
I do. I think that is the end goal. We're some time away from that, but this is about making capital allocation decisions based on the risk that we think that company is either effectively managing or not. And the data allows us to get a bit of insight into that company to know whether it is being managed in a way that meets the goals of CalPERS, which is to be net zero by 2050, to look at human capital issues, look at the governance issues of those boards. So I'm excited about this. I haven't been this excited about an initiative in quite some time. I believe that this one is on the path to success. And I say that because of the demand, the number of LPs and GPs who really wanted to be a part and coalesce around these metrics. Consumer demand is going to continue to change, and companies that do not pay attention to what is important to the consumer, those are not going to be sustainable companies in the long run. And for CalPERS, our liabilities are evergreen. And so we need companies that are sitting alongside of us, thinking about the long term, not just the short term revenue growth.
Now, one piece of that data that's not necessarily about green initiatives, more of the sustainability part of this as well, is that you're looking at employee engagement. You're somehow tracking it among the portfolio companies owned by the investors that you invest in. So, I think the reason it is so relevant right now is we're in the middle of this great resignation. So I'm wondering how, employees being happy, employees being able to get what they need, employees, as we see them unionize or seek to unionize across the United States, how does that all play into your decision making here about making that an investment decision?
So I believe that employees who are highly engaged are also highly productive. Employees who enjoy coming to work, have the leadership that really sets them up to be successful, gives them the resources they need to be successful, that those companies are going to thrive in the long term, whether that is a brand of that company, whether that's the ability of that company to recruit the top talent that they need. Once they recruit that talent, are they able to retain it? And so the way that engagement surveys would need to be done is it really needs to get at the heart of the matter of what makes a productive employee. And I think I've mentioned a few. It's around leadership. It's around having access to resources. It's promotional tracks. It's a fair and equitable system for promotion. It's the culture of that company and that brand that they have, that they want to be able to net promote that to others. And so that engagement survey, the initial part of the data reporting would simply be a yes, no. Are you doing an employee engagement survey? And that would be an indicator whether this company pays attention to culture or not. And then beyond that, where I would like to see this move, is start reporting out on some of the key measurements within that engagement survey that gets at employee engagement or employee satisfaction.
I want to shift gears a little bit to the green initiatives that you're undertaking. There was a report out this morning from Stand.Earth and Climate Safe Pensions Network that showed that the two top California pensions are the largest investors in the pension industry in fossil fuel companies. Now, you've long kind of met a lot of demand to divest, and I'm wondering how your conversations with the people who are asking you to divest have evolved and changed over the last couple of years.
Thank you. Yes. So the way that we explain in the report that had come out, that obviously that is a factual report, but if you look at CalPERS at almost 500 billion and CalSTRS, somewhere between 3 and 350 billion, we're the number one and number two pension systems in the United States. So it would not be a surprise that our holdings would be larger. But for CalPERS, we have three ways in which we address sustainable investing, and that's interchangeable with ESG in our view. But we look at engagement, and engagement for CalPERS has been extremely effective, we believe. Climate Action 100 Plus just created a new benchmark because, again, a lot of lacking data around greenhouse gas emissions, the consistency of that reporting, the subsidies that are going into that industry, the lobbying money that's going into that industry. So we now have created a benchmark through Climate Action 100 Plus, of which we started. We're now just part of the 55 trillion in assets behind that initiative. So that's a recent success as well under the engagement. The other is our policy work with the SEC, with other international regulators, the IFRS, and really seeing, because we're a global investor, it can't just be that the US is demanding or requiring certain kinds of reporting. We need this globally because we are a global investor. We're not just invested here in the United States. And then the third one is really around integration. So how do we integrate everything that we've learned through this data, through these benchmarks, through some zip code risk reporting that we just started doing on our real assets portfolio and our real estate portfolio? How do we make better risk-informed decisions? And is that an investment that will withstand our sustainability test for the next 5 years, the next 10 years, the next 15 years? And so being an entity like CalPERS that can really push the regulatory environment, can really push particular companies to talk to us about how they're transitioning. And we believe that has been highly effective. And it's going to take more than a CalPERS to do this. CalPERS simply divesting from these assets, it simply means someone else is going to hold them who may not have the same priorities that CalPERS would have.
Well, speaking about the regulatory framework here, the SEC, there's been a lot of talk about them moving to require more disclosure, but that has not yet happened. At what point will we see that? And how aggressive do you think that we can get in the next couple of years in terms of regulatory disclosure in the U.S. that's mandated by the Securities and Exchange Commission?
Mm-hmm. Well, we've seen some movement here. Chair Gensler has, certainly this has been an area of focus for him on the mandated reporting. But, just because reporting is not mandated doesn't mean that these companies should not be doing it. They have the ability to do that today. And, frankly, we do get some of that information in more of our private interactions with public companies. And so through, our proxy, we have the ability to have our voice through proxy voting season. But the time frame of this, with everything else that's going on in Congress and all of the priorities, it could be some time, frankly. But I would really encourage, public companies, private companies as well. The private companies are willing to do this for limited partners and investors. I don't see why public companies wouldn't be able to do the same on a more voluntary basis. But the mandated reporting, I believe, will take some time to get in place.
I'm interested also in terms of how you're shifting some investments away from traditional fossil fuels to alternative energy.
Mm-hmm. We've actually found a number of opportunities more on our real assets, so solar, wind power, more so than in our index funds. And 20% of that portfolio is now in renewable energy. So we are finding some opportunities around our requirement of that it has to pay us in a way that meets our expected rate of return, our ability to pay these benefits for decades to come. We pay $27 billion out of this portfolio every year to pensioners, and so that growth assumption and the growth of the portfolio is extremely important to sustain those pension benefits for those 2 million people. But we are finding opportunities. They're not coming in, maybe as quickly as we would like to see them, but we are finding more opportunities with that 20% in our real assets portfolio now in renewables.
Now, I'm wondering also, California obviously has been a place that's faced tremendous climate change pressures when it comes to the fires, for example. We have seen, water rationing in many different places. What kind of pressure have you felt personally and among constituents to move faster?
Mm-hmm. There are many people out there who I call them experiential learners, and California has certainly had a lot of experience with wildfires in particular. Tahoe, Lake Tahoe, which is just an hour away from Sacramento, and the Caldor fire that was there is one of them. It wasn't the only one, and just the devastation that has caused to that really beautiful area of California, let alone the number of people who lost their homes, the number of animals and wildlife that was lost there as well. And so we do hear the pressure to move faster, and we understand that pressure. But the transition it's not one of those things that you can just flip the switch and we're transition completely this $500 billion portfolio into something that looks completely different. But we are on a path, and I believe it's the right path to get to that net zero. But there are 3 types of emissions, right? So there's scope 1 and scope 2, that if the divestment pressure about divesting from fossil fuel companies themselves, that might address the scope 1 and scope 2 emissions, but that's about 20-25% of the portfolio. Most of the emissions are in scope 3. Those are in the supply chain, and that's about 75 to 80% of the emissions. So having Calpers to divest from fossil fuel companies does not accomplish the goal of being carbon neutral by 2050. We have to be involved in this. We have to continue to have a really important role in this transition.
Yeah, and obviously we've talked about this before, that scope 3 emissions has been hardest to track the data for as well. This has also been a huge year where we have seen activist investors like Engine Number One come up and make tremendous change. How are you taking a more active stance? And do you find yourself aligning with investors like that more and more to create a greater change?
We do. We were certainly a part of that campaign. We felt that, the G, if you will, and ESG is around governance of these companies, that these companies are managing those risks that we've spoken about, managing the transition activities that need to occur. And we didn't believe that was happening with that particular company, and that there needed to be more independence on that board, and there needed to be people who were thinking about that company differently, perhaps than the company in its prior decades. And so we were part of the campaign. If we believe that it aligns with the goals of CalPERS, you will see us become a little more activist, but you'll see us become more active during those proxy, activist campaigns.
Before we let you go, we should take a question here from the audience. And this is coming out of COP26, obviously a landmark year for discussions among governments on the topic of the environment. What are your thoughts of the formation of the ISSB coming out of COP26 and other efforts, frankly, that might help you do your job better?
Well, I think it goes back to, this is not something the asset management industry can accomplish on its own, or the asset owners like a CalPERS. And this is something that, the global community, whether those are governments, whether those are investors, regulators, financial disclosing entities, that we all have to come together to really meet the goals of the Paris Accord and now meet the goals that came through COP26. So I'm optimistic, and it's appreciated to see the coalescing around this. And so, we'll see next year. I'm a we'll see kind of person. person. I'm an optimist about the future, but I'm also really steeped in reality. And these things can get big quite quickly, can get bureaucratic quite quickly. And so, as long as we set the goals appropriately, we have data to measure whether those goals are making the progress that we expect them to make, and that data is available to asset owners and asset managers, then we can make that transition appropriately. But there is a cost to this transition. There's a cost that really is the subsidies that are going in today into the markets and not pricing carbon appropriately. That's a primary goal, I think, coming out of COP26, is that we have to get ahead of that and get the incentives set up differently.
Well, I mean, that's the next question from our audience. Your broader thoughts here about the carbon markets, and you started to get into that issue with the pricing issues here.
Mm-hmm. We've been a long, staunch supporter of having pricing on carbon, and that is certainly part of our policy and advocacy work that we've been doing, probably over a decade. That it's a free ride today. We can't have a free ride on carbon. Eventually, there will be a cost to repairing the damage from carbon. Who will be the payer of that? That payment needs to start happening today. The subsidies, and I think it's subsidized in the markets. I think that there's lobbying activity and lobbying money going in that needs to also stop immediately and really start incentivizing the markets into new innovation and new technology that will help this path to move, faster than what is projected to move right now.
We're getting one last question for the audience, and it aligns with what I wanted to ask you, is what about next year? What about the 2022 season? And they're asking specifically in terms of proxies. Do you have any thoughts on what next year brings?
We will continue our work around board diversity. That's an extremely important priority for CalPERS. We know that more diverse boards, more diverse companies have better productivity and better, they're better managed, better innovation. And so that will certainly be a top priority for proxy season. We will also continue to ask companies around the independence of their directors. That independence is important as well. But those would be a couple of priorities for us.
So companies with the super voting shares, there's got to be a day and time for you.
Dual class shares are always, yes, dual class shares as well. That's something we're very watchful of.
Yeah, interesting. Coming out of California, as we know, the San Francisco companies have had a lot of that. Anyways, lastly for you, Marcy, before we leave you, 2022, I mean, if you could set one goal to kind of hang our hat on into next year, what would that be to look out for you for?
I think it's around implementing our new strategic asset allocation. The board approved a very different asset allocation for the next 4 years, adding in 5% leverage at the total fund level, adding additional 5% allocation. We're currently at 8, adding another 5 to get to 13 for private markets. And just being able to successfully maneuver the portfolio into that new strategic asset allocation. The other, I think, for us is really the workforce. And the workforce here at CalPERS, we're coming back into the office, starting our transition more fully back in after January. And then for the markets, I think it's really watching interest rates. There's different debates about what people think interest rates will do, what will happen with this new variant, what happens with the continued increase in the Delta variant. And so there's some known unknowns out there. But for us, it's really implementing that new strategic asset allocation and reassuring the 2 million members that their pensions will be sustainable.
Certainly some big challenges to maneuver. We'll be looking forward to catching up again with you soon. That is Marcy Frost, the CEO of CalPERS. Thank you so much for your time.
Thank you.
Hello, everybody. Welcome to the Sustainable Business Summit. This is the round where we're going to be talking about financing the clean energy transition. My name is Tara Narayan, and I'm a senior associate with Bloomberg NEF. I'm really excited to be speaking with a wonderful group of panelists that we have here today. And so please join me in welcoming to this panel Dr. Katja Gracheva. She is the lead finance officer at the Climate Investment Funds. Ruben Munger, managing partner at Vision Ridge Partners, and Glenn Pierce-Oroz, Senior Director, International Relations and Special Projects at Sustainable Energy for All, so called SE for All. So welcome, everybody. It's great to have you here. This is a fairly tight panel, and so I'm pretty sure everyone listening would really like to just get straight into it. And so my first sort of general background and question to you is that the clean energy transition is one that really cannot happen quickly enough, and mobilizing capital to that end is key. Given the sort of diversity of expertise that we have on this panel, if you would be willing to give a quick background about yourself, your institution, and then share some of your thoughts about where we are today, I think that would set the stage for everybody listening in. We can start with Glenn. You're closest on my screen.
Great, and thank you very much, Tara, and thank you to Bloomberg Sustainable Business Summit for inviting SE for All to be part of this important conversation. As I'm sure my fellow panelists know, and many of you who are tuned in, Sustainable Energy for All began as a UN initiative, was spun out of the UN. We're now an independent international organization focused on SDG 7. And that also includes the energy transition and Paris alignment goals. So the way we look at the clean energy transition is that I think that we're coming close to an important political pivot. And this political pivot has everything to do with the diversity that's out there in terms of energy transitions. And so a few years ago, we started hearing more and more about a just energy transition. And now we're starting to hear much more loudly the importance of anticipating a just and equitable clean energy transition. And the way, at least we're thinking about it, is the just transition came about as a result of a recognition that there were going to be winners and losers in a clean energy transition in many of the developed countries. And the Katowice COP24 was very clear on that. However, when we think about an equitable transition, this is really leading to the differences that we see in different economies in the developing world, where social equity is still an important issue, development is still a frontline issue, and so a just and equitable clean energy transition is a better way of capturing what needs to happen in different stages for different countries. I think, Tara, to your question regarding mobilization of capital and the importance of that mobilization, again, I think there are ways of looking at this in a very optimistic manner. We saw earlier this year the GFANZ, the Glasgow Financial Alliance for Net Zero, get off the ground. We saw more commitments in Glasgow around what private financing can do to be able to make that leap from billions to trillions. There is momentum, but it is uneven. And perhaps that's one point that we can pick up a little bit later. It is uneven across the board. And this goes back to SDG 7 by 2030 if we are going to get to a net zero by 2050.
Definitely. Again, going on who's on my screen next. Katja, your thoughts.
Thank you for the opportunity. And let me pick up on a previous speaker. The momentum is strong and rhetoric is quite pervasive, and it clearly feels like a pivoting point. But the reality is it's still yet to translate into measurable flows for energy transition, and the task is complex. We at the climate investment funds that have been set up after 2008 crisis that demonstrated how vulnerable flows to emerging markets have been at the forefront of deploying capital to developing countries for a number of climate-related programs. We are programmatic, be funded by sovereigns, the G7. And we have deployed about 8.5 billion in concessional capital to mobilize about 60 billion across 72 markets to help them achieve their low carbon transition objectives. And at COP, we launched 2 new programs that are quite in tune with the times, because we are evolving. This is the objective of the fund with the times. 2 new programs accelerating coal transition and renewable energy integration in developing countries. Because while in developed markets, the coal transition is well underway, in developing countries, the task is still much more challenging, and we would be the first program to take on holistically. Just to illustrate how we think about energy transition in emerging market economies, and the previous speaker spoke about this, is fossil fuel is at the cornerstone of economic development of many countries, both from the energy supply to economic jobs and various economic activities. Many countries that rely on fossil fuels are mono industry, and the transition, just transition in particular, as was mentioned, requires significant transformation of the entire economy, huge focus on transformational government policy, regulatory frameworks on communities and people to ensure that transition is just, because if it's not a just transition, it's not a transition. And the emerging markets will experience significant growth in energy demand, and they plan to meet it with the growth from coal. And in fact, just as an example, a couple of statistics. Current coal production generates 2,100 of gigawatts of energy. Right now, 140 new gigawatts of energy of new power plants has now been developed, and 400 gigawatts is in different stages of development and design, which represents 25 increase in coal production, which is a stark contrast to the decommissioning that needs to happen, very aggressive decommissioning that needs to happen over the next decade. So the pivotal point, the political momentum is here. The task is challenging, and happy to later in this panel to talk about the challenges specific to flows to emerging markets for these sorts of activities.
Sure. Ruben, can you tell us a little more about Vision Ridge and where you think we are today?
Absolutely. It's a pleasure to be here, and thank you to Bloomberg for this opportunity. It's a great panel and a really interesting perspective. As at Vision Ridge Partners, we've been investing in sustainable real assets and infrastructure primarily in the developed world, but since 2008. And so the framework of how the acceleration over the last 10 to 15 years around the economic opportunity and therefore scale of both capital availability, but also viable, attractive solutions has increased dramatically. And so when we began, often you were looking for interesting sort of special subsidies or certain market structures that provided really attractive returns. And that's been our viewpoint, that investing in this transition is a way to not just participate in infrastructure and real assets in a traditional sense and have similar return opportunities, but the future of those categories are effectively sustainable. So real assets and sustainable real assets converge to being the same thing over time because the economy and the world can't support something different. And so what started as small or niche opportunities now have tremendous scale. And so there are opportunities here in the US, as an example, where you are able to displace some of the exact coal-driven power systems that we were just talking about with renewables in a way that is cheaper than the marginal cost. And so the private markets, with our backing, as an example, we have an investment that has stepped into that breach, is helping communities transition both in a sort of what is their source of power, but also what is the economic implications to their communities of that transition. And effectively, the cost and economics underlying the shift means you can save money, become greener, create local jobs, and do all of those things at the same time. And so what I think is really interesting is kind of how innovations or activities that are taking place in more developed markets can then move into the emerging markets and work with partners like those on the panel to sort of absorb and address the differences and risks. But it really is a massively different place in terms of the scope and scale of the energy transition. We really are, in the developed world, talking about trillions. And the subsidies, or the U.S. again, right? We had bills passed in 2008 that subsidized energy storage or electric vehicles, but the cost of a battery in a vehicle is 10 times less today than it was then, and the dollars being put forward by the federal government is 5 or 10 times more. And so on a per kilowatt hour basis, the amount of policy support going on is 50 to 100 times greater. And so the impact of private capital to leverage that is unprecedented, and we're in a totally different place, and it's quite exciting.
Yeah, a number of different people mentioned the transition away from coal, which I think it's really important to remember. It's not just about financing renewables or funding clean power generation, but it also involves moving away from fossil fuels, and that requires some funding as well. I know different people have experience with this. So to get your thoughts on how we finance this transition away from fossil fuels, Ruben, would you like to go first?
Sure.
With actually some examples, what you've actually worked on.
So as I was mentioning, we have a business called Gooseman Energy that is focused on exactly this question. In the Mountain West, we are a coal-dominant supply community, but the marginal cost of providing coal power is greater than the marginal cost of replacing that portfolio with new construction of, as an example, solar and wind and other firming strategies. And so when you put together that economic paradigm, you're able to, and this company does, effectively finance the buy down of that otherwise stranded asset. And so you can accelerate the closure of a coal plant, set aside capital for community transition, and work with the state and others to sort of really help the community that is going to lose the employment of a coal mine and a coal plant. But so you can allocate capital to that, and you can commit to lower costs in the sort of customer community while then going and building, as an example, a solar power plant. So, we've worked with specific communities where you kind of execute those three things, and you say, okay, here is capital to retire the coal, here is capital for the community transition, here is capital to build a new solar power project in your community. And this isn't, a small distributed thing. In this case, it's an 80 megawatt power plant. And so when you do those three things, and all of that fits within a return to private capital and, sort of lower, longer term, cheaper power to communities, it's sort of a massive aggregate win. And so, what was interesting in preparing for this is how those examples can then be ported to other markets, because it really is the idea of stranded costs is one that is attached to bad capital decisions of the past, and the new economics are effectively have changed so much over the last 10 years that you can make the transition and effectively absorb those costs. And so often stranded costs are used as an excuse to slow down change, and in fact you can leapfrog it. And the parallels to telephony, I guess now 20 years ago, where it didn't make sense to build a fixed line communications network in emerging markets. It made sense to go straight to mobile, and you have effectively the same opportunity as we look at how to satisfy electricity growth and demand for an equitable and just transition. So that's sort of in a developed market of Colorado, that's the way it has worked, and yet the math is global, and we just need to tap into it.
Tara, if I may, because I think Ruben makes some really, really good points, and you do a good job of really characterizing, what the situation would be in certain markets in the U.S., which is extremely valuable. And just to give a bit of perspective on how different markets may be elsewhere, I often keep in mind the kilowatt per hour per capita per year figure, which is according to Energy for Growth Hub. They did an excellent study earlier this year. They identified that most sub-Saharan African countries and developing countries are only at about 200 kilowatts per hour per person per annum. The middle and upper income countries are 3,000 kilowatts and above, and economies like the US and Western Europe are at 6,000 plus kilowatts per person per annum. So you go from 6,000 kilowatts to countries that are dealing with populations where they can only provide 200 kilowatts. That frames well the different challenges that Katya and myself had mentioned as well, in terms of countries that have a double challenge of developing out their energy infrastructure while at the same time trying to be as green as possible. And this is why I think it's extremely important to start thinking in terms of, who are the low emitting energy poor countries, such as the ones that I just described, versus the high emitting dynamic economies, which could be found in Southeast Asia, which could be found in South Asia, versus the high emitting energy abundant economies, which are some of the ones that Ruben was describing. The energy transition will be different in each one of those categories. And that's the real challenge, I think, that we have as a global community, is figuring out what are the lessons from each of those categories to cross-fertilize, but recognize that there's a hell of a mountain to climb for many of these economies who are still trying to get, up to 1,000 or 3,000 kilowatts per hour per person per annum.
And if I can pick up on this point in particular, just to put this within the context of what SIF has now agreed to do with its donors, and who capitalize another $2.5 billion for that work on accelerating coal transitions. We're working on this climbing that mountain. We started in 4 countries, South Africa, Indonesia, India, and the Philippines. And it's a huge mountain. You don't see the top of it when you start to engage. And it's quite a challenging proposition of working with the policymakers, because there is not even a consensus within the political and policy circles on the appropriate transition. And a lot of work, upstream work, before even structuring specific repurposing of a coal plant, a closure of a coal plant, or investment in renewable energy, requires to just even upskill decision makers to evaluate different options and bring consensus in policymakers, bring on board public operators of the energy distribution systems, financiers. And it is exacerbated by the lack of access to capital, because in most of these emerging countries are below investment grade. Only 2 low middle income countries are investment grade, and it puts them in a particular risk category, both real and perceived, in terms of, even if you agree with the policymakers on putting together a transformational plan, which actually takes a lot of effort and plan, you are struggling to mobilize the private capital to actually execute those plans. So that mountain, I agree, is huge, and economics and political realities and political economy of the places are quite unique. And absolutely agree that no one-size-fits-all approach here would be appropriate to the countries that will be relying on fossil fuel for energy growth in their economic development.
I just wanted to jump into that categorization because I think it's a fantastic point and would almost question whether the right phrase is either just transition or energy transition for those countries that are truly energy poor, right? And so, using some of the experiences where, we've built a large utility-oriented battery business here in the U.S. and recently sold it to allow someone else to scale it. Those are technologies that can then help facilitate the right energy development and energy access in some of that sort of first bucket that you were talking about, where really it's not a transition, it's we need to get cheap power that is reliable and deployed into the communities and places that it's needed. And that's a different question than what to do in that middle category you were describing, which is they're vibrant but have a lot of power, some of it dirty, and therefore need to make it cleaner. And it's interesting when you go all the way back to the U.S. One of the major debates we have now at our grid level is how do you fund the transmission to scale across geographies? And we already have a much more robust transmission network than emerging economies, but it doesn't necessarily make sense to build transmission first to bring access if you can bring power first in a distributed way and then link the system later. And so what are the technologies and things we're doing? And we're battling, there's a question of is it better to have 24/7 green power? Or is it better at the margin to find higher emitting sources and reduce those? And so are we emitting, or, is the largest, companies in the world are really grappling with this today. Is it better to force the grid you're on to be cleanest, or is it better to spend money reducing emissions anywhere and therefore effectively offsetting activity, and how to bring that to this transition conversation? Because there are cheap ways to reduce emissions, and then there are green and cheap ways to bring power at the margin. And somewhere in between is this system change that is, how do you solve maintaining growth in Southeast Asia and moving it off coal all at the same time. And that's almost the hardest of the boxes, because I think what we've seen is the math works in the energy poor areas and can be a real accelerant if we can solve the policy gaps.
I just wanted, there's a lot of really good ideas here, and I actually had a couple of follow-up questions. But I just wanted to interrupt really quickly to say it might be good to just take one of the questions that we've gotten from the audience to potentially close this out. And that is, among all of the different things that we've spoken about, the challenges that have been identified and laid out and how they play out differently in different countries and communities, what do you feel is missing in the energy access space? And more importantly, what further support do investors and funders require to actually move the market?
So in terms of, thanks very much, Tara, for that question. In terms of energy access, what we are seeing is that it goes back to reliable data and making sure that we have the right data in these countries. We monitor, as some of you may know, we monitor the 20 high impact countries, which are the 20 countries which represent 80% of the electricity deficit globally. And that's roughly about 790 million people who still do not have basic access to electricity. And so we're looking at these different countries very carefully and looking at what the financing looks like that's flowing into those countries. One of the elements that is helpful in this regard is where countries are able to, and governments are able to start identifying what are the different solutions that are available for different types of populations. And so what I mean by that is it's never going to be all on grid. There will be significant percentages of the population that will need to have off-grid solutions, mini grids, microgrids, even solar home systems. In some of the projections, for example, in Uganda, they will have to rely on over 50% of their solutions to be off-grid. And that's a 20-year projection. And so once governments start appreciating or understanding that that is what has to be worked towards, then they can better provide some guidance in terms of their policies and incentives and regulations, regulatory clarity for the developers who need to come in and for the financiers who need to finance the developers. So data, I think, is hugely, hugely important. And part of that, if I can link that question back to what Ruben and Katya were mentioning, we've had a really interesting and constructive experience with the Energy Transition Council, which was an initiative launched by the UK COP26 presidency, co-chaired by Sustainable Energy for All. Includes many of the actors, Katya's colleagues at the World Bank and many other development banks and the IEA and IRENA and ILO, many other bilaterals. And the effort has essentially been, how can we, as a global community, encourage more ambitious energy transition in specific countries that are leaning in that way? And I think you hit the nail on the head, Ruben, when you said in many countries in Southeast Asia, the response was, we would love to do it in a greener way, but we've got a dynamic economy that we have to feed first. So help us figure out how we can do that in a cleaner way, and we'll be on board. But that's where the rubber meets the road, and we now need to start making good use of the mechanisms. One of them that Katya mentioned at the beginning, the energy transition mechanism that the Asian Development Bank has launched, the efforts around South Africa to help ESCOM in its multi-country effort to help ESCOM retire some coal-fired power plants. So, I go back to one of my first points, which was we're at a pivotal point. We need to follow up the politics with these mechanisms that will be helpful to get the transition right and right-sized in the different types of economies.
If I can jump in to add a different perspective to it, since it's we're talking about financing for transition, I think the technologies are available, and we already can learn from transition happening in, let's say, as US, as Ruben has been explaining. The reality is financiers, capital, access to private capital is a significant bottleneck in making this happen. Even suppose if we can put all the policies together, etc., the reality is private capital has not flown into the space. And in fact, COVID and other developments in the space like ESG, in fact, is driving capital away from emerging market countries. We see it on our flows, and it requires us to have greater sources of patient risk-taking capital to be able to incentivize de-risk and subsidize private capital that comes in, because what we are seeing on the ground is that they come into, even if they come into the emerging market, they stay with the familiar asset class, like infrastructure that is quite well developed. But we need to go into the new areas that would require dealing with lack of adequate data or poor quality data, or make decision in a policy challenging environment. And that requires for all of the different shareholders and stakeholders in this process to lean in and be willing to jump in the absence of, let's say, some of the clarity, regulatory clarity that, let's say, developed countries enjoy. So I think there needs to be a little bit more forward-leaning approach and jumping into this to try to solve the problem rather than relying on the old ways of doing business. That hasn't worked so far.
Absolutely. Ruben, any thoughts on what's missing in energy access, what support investors could do with to move markets?
I mean, I think it's a challenge because it's complex, and yet the scope, scale, and opportunity outside of energy access is so significant that I think that we were just sort of touching on the complexity of really diving in to do the smaller activities that ultimately bring the solution is a great deal of hard work. And so it's really important that people are working on it. But capital providers are stuck in the tension between, how quickly you can be effective in so many other places versus this challenge. And so it's sort of what are the pathways how do you create a low enough friction path that capital can go engage in ways that are below that traditional sovereign level infrastructure that has defined power supply in some of these markets. So the learning is taking place on one side, and so then how do you get to where it's effectively either the returns are high enough or the structure is accessible enough that you bring the creativity that is existing in other markets to this problem.
Yeah, I agree. Everybody, thank you so much for all your thoughts on this panel. I think it's very fascinating to get everybody's thoughts together, because while everyone can agree that a transition needs to happen in a just way, in an equitable way, the challenges are really obvious. And as Katja says, we can't expect to continue the old way of making decisions and hoping that financial flows will just automatically take care of themselves, because there's lack of data. Translating the learning to actual applications is hard. And so simply moving forward with a determination to actually do things with the acceptance that there cannot be the simple, straightforward paths that we're used to seeing, at least so far, is critical. And hopefully this helps some people in our audience move forward. Thank you, everybody. And with that, I think we'll turn it back to the moderators.
That brings us to the end of day one of the Bloomberg Sustainable Business Summit, Focus on Finance. Thank you to all of our speakers and our moderators for their insights. And thank you to our global advisor, Natixis Investment Managers, and our summit advisors, BMO, Flex, Salesforce and Accenture, Schroders, Wells Fargo, for making this virtual summit possible. If you'd like more information from any of our advisors, please visit the resources tab on your screen. And most of all, I'd like to thank all of you for being such an engaged audience today. We'll be back tomorrow at 9 a.m. Eastern Time for day 2 of the summit. We hope you'll join us then. Thank you for watching.